doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
Look who's back testing. tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at tastytrade.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to tastytrade. So spread the word and earn rewards. Terms and conditions apply.
Stocks blew a 14-point lead with 2 minutes left to go. Oh, no, wait, that was the next. It's Thursday, May 22nd, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan to take you through the rest of this hour. Futures market closes at 5 p.m. Eastern. If you're joining us on the platform, joining us on tastylive.com, thank you for joining us. Come over to YouTube, join the chat, tell us what you're trading, what you think of today's action. Stocks basically flat. They give up their gains into the close, but it's not like we turn real negative. Russell is up now by 0.06. S&P is up by 0.01. NASDAQ's up by 0.2. It turns out to be a real nothing of a day. We start the day, of course, with news that the House Republicans do indeed pass Trump's tax bill in a razor-thin vote, 215 to 214 to 1, because a Democrat died overnight and someone else fell asleep on the House floor. I'm not kidding. And so now it moves to the Senate. We see that today the bond market sells off and ZB hits a new yearly low before bouncing back.
You're saying the reason that passed the House is because someone died and someone fell asleep? Did I get that right?
Yeah, that's my claim. Oh. And I bring,
right,
and as you know, I have receipts. I have
when the margin is only 2 votes. I mean,
anyway, you were doing your drive time lead there, and I interrupted you. I'm sorry. So please.
Driving us off a cliff. Gold, silver, come back in a little bit. Oil also to the downside as the Iranian tensions seem to cool off, and we're still digesting what the ramifications of those inventory figures have been, which show greater drawdowns than anticipated during a week where we were expecting, bigger drawdowns, and we got bigger builds in the inventories is what I meant to say. Otherwise, the dollar meanders back and forth. We see that there's a little bit of a turn lower in the euro and really across the entire currency complex. Stocks today, as we go to the charts, ultimately dojis, if you will. The S&P 500 settles in right around 58, 55 or so. It's an area where the uptrend off the April lows arrives. Likewise, it's an area where we find the bottom side of the range that was carved out October, November, December, January, February until the break at the end of that month. At the end of February, we did have a set of PMI readings that started a growth concern. February 21st was that date. 3 months later, we have a new set of PMIs here today, Ilya, which I know you've been champing at the bit, by the way, to get towards, because quite frankly, this has been a week where we haven't had that significant stretch of U.S. economic data. But the PMIs today weren't terrible. Can you break them down for us?
It really depends. The headlines were much better than expected, but then you looked under the surface and saw why they were that way, and it was a sobering experience. And if you looked at
sobering
the numbers,
why?
Yeah,
so if you looked at the numbers,
elaborate.
If you looked at the numbers at face value, they gave you a pretty welcome rebound. So in April, the U.S. economy basically stalled, almost stalled, barely any growth at all. It was the weakest numbers in something like 15 months. And where you got to for the May survey, and we'll see how it's revised. These are preliminary numbers, but clearly you're looking at a little bit more activity. You get a rebound. It's not a strong rebound, but it's a rebound, and the numbers are much better than expected across both services and manufacturing. But then you go and you look at why they are. And you see that inventories have jumped by the most since PMI records began 18 years ago. You see that costs are rising at the fastest rate since the COVID peak almost. The COVID peak is June of 2022. This is the fastest inflation since August 2022. You see employment is cut across both services and manufacturing. In other words, what you see is front running of the new cliffhanger on tariffs, but no confidence that this is going to continue, because then you'd hire more people if you thought the thing was turning. But no, people are cut and inventories are stocked. And this actually creates a very scary situation going forward, because if this is anything like what happened in the first quarter, then businesses are front running. That makes sense. They're going to insulate consumers from these costs again, ostensibly, as they did in the first quarter and going into the second. We just saw this in the PPI numbers. But consumers won't show up. They didn't show up in the first quarter, weakest consumption in almost 2 years. They didn't show up in the latest retail sales numbers, though they were insulated. And consumer confidence has absolutely cratered. It's at COVID-relevant lows. So you're in a situation where businesses are essentially racing to be stocked up ahead of what could be, who knows, with the tariffs come July and August when these reprieves expire. But if consumers don't show up to buy all this stuff, well, then businesses have just shelled out all this money to cover consumers' costs and build these inventories, but nobody came. And now that's just a non-performing investment. It's consumers that have to come and buy this stuff. And in the first quarter, they didn't really have much appetite. And the data going into the second quarter is telling you it hasn't improved. There's no growth without consumption.
Dylan, be that as it may, doesn't this paint a picture where over the next few months it's going to be very difficult to read any economic data that comes down the pipeline, because it's going to offer a muddled, mixed picture? And, I suppose if we want to look at this through the lens of the Fed, doesn't that mean that we should expect no help at all coming soon from the Federal Reserve?
Yeah.
Well, I mean, the short answer to your question is yes, I suppose. However, you've got a sort of small rack of assumptions in there. One is you're saying the next, let's say 6 months, let's say the rest of the year, the hell with it. It's almost June. Let's say the economic data for the rest of the year is a mixed bag, a little something for everybody. The Fed's still going to cut rates. I think the only reason the Fed doesn't cut rates, obviously, is going to be because of, I mean, I say that probably far too casually, but I feel like the relevant, I guess what I'm getting at, to be more direct, is I feel like the relevant force is the Trump administration, the tax bill, and the tariffs more than relative to, and the bond market. Like, I still think the story is the bond market. And I think the bond market's reaction to that House passage of that tax bill is not good. And I think that the bond auction was not good. I'm me and everybody else. I guess is the point that you're getting at that, well, whatever you like, in order to create relief, you must have explicitly weak economic data and explicitly benign inflation data, and absent explicitly benign inflation data and explicitly weak economic growth indications, you're kind of stuck in a this is like, we're, I don't know if this is 2024 or 2023, but we've been in this conversation before.
Yes,
just with a different president. But
Yes,
we've been, and I think the market did fine after. I mean, the market doesn't. I feel like this is why people buy the dips.
The trouble,
with all due respect,
the trouble with all of this is basically the same architecture that's existed since the middle of last year. The Eurozone numbers overnight came out absolutely awful. Japan
what numbers were those, Ilya?
This is so all of this that we're talking about is the S&P Global Purchasing Manager Index numbers across a whole host of major economies. The U.S. ones
is some sort of a upstream supply chain demand indication.
Exactly. So they go and over the course of about a week and a half, they poll a bunch of
more
purchasing
stuff or less stuff for the big companies.
Right. They go and they poll a bunch of purchasing managers because they have to manage supply chains and think about what future demand is going to be. And so they have an inherently forward-looking lens in the real economy. And so it's a good barometer on where GDP is heading, because as these guys either stock or don't stock, hire or don't hire, plan this or plan that, so too you get a lens on what the business cycle probably looks like, and it's a very timely kind of anticipating measure for GDP. So you got these numbers overnight from Australia, Japan, the Eurozone, the UK, and the US, most notably. The Eurozone is in shambles. It's
as you're saying, the data implies a very
awful. Yes, the economy is basically back in a recessionary dynamic. So shrinking manufacturing, shrinking service sector. Japan's economy shrinking.
But isn't all that demographics? Not to dismiss it, but is that a function of the economy, or is that a function of Europe and Japan as a bunch of old people?
No, it's a function of the economy, because this is faster
cycling.
This is more kind of current data. This is what happened with the pace of economic activity across manufacturing and services from the previous month to this one. Did it grow? Did it shrink? Did it accelerate? Did it decelerate? This is higher frequency stuff. The demographic stuff is, of course, there, but that's a slow crawl over many years.
That's a 50-year problem. It's not a 3-month problem.
Right. This is more like, what does growth look like? What's the impulse for economic growth into the second quarter? Mm-hmm. This is like right now. Mm-hmm. So, and Europe looks terrible, and the UK looks terrible, and Japan looks terrible, and Australia has slowed from growth to basically standstill. So there's weakness everywhere, and there's also rising costs everywhere. We saw a lot more inflation. I mean, CPI numbers this week out of the UK, out of Canada, out of the Eurozone, their final numbers, also inside these surveys, more forward-looking inflation numbers, surging across the board. And so the fear becomes stagflation. And this has been sort of some kind of coordinated global recession, if the U.S. falters, has been a risk since the middle of last year, because Europe is not newly weak. It's been weak. China is not newly weak. It's been weak. Other economies are not big contributors. So if you lose China, the Eurozone, and the U.S. together, you have a global recession. There's nowhere else to go. That's almost all of global demand. And so that you get a reprieve in the U.S. here, seemingly, tells you that basically worldwide stagflation got a little bit of a pushback here for a little bit. But then you look at the internals and you're
saying the relative strength of the American purchasing manager data is a step away from the most awful stagflation narrative you might spin.
Yes. Whereas in April, everything looked absolutely like it was careening in that direction. We're not careening here, but you look at the internals and you go, but what this means probably is the Fed continues to sit on its hands because it's confused and thinks that it needs more evidence. And to Chris's point, growth is going to have to come apart in a much more aggressive way that unmistakably starts to kill inflation with weak demand, and only then can central banks act. We saw that CPI numbers this week diluted Bank of England rate cut expectations, diluted Bank of Canada rate cut expectations, diluted ECB rate cut expectations. So the markets are basically going, central banks are going to be slow to act. Growth is going to have to really kick people in the face before they do. And in the meantime, this thing is going to fester.
Dylan, for today at least, we have a stock market that's able to push modestly higher. It's an inside day across the board, so it's not really something of significant substance, although I suppose the place where we're stopping at, Ilya, is a good place as any if the market is going to hold up for the bulls, right?
Yeah.
You wouldn't want to see a deeper sell-off here. And I suppose the day that arrives, with today being a corollary to February 21st, we don't have that spark in the PMI data like we did back on February 21st that ultimately pushes the market over. You know, if those PMIs fell below, like services PMI falls below 50 today, Ilya, I'm thinking that S&P is a lot weaker. NASDAQ is below
S&P
21K
dumps off,
again.
yeah.
Right, and that's, you know, it's ultimately a good thing that we pause where we ultimately do pause. Now, if tomorrow we find a little bit more follow through, you can make the case for the NASDAQ here. Evening star candlestick cluster, you have your key reversal from yesterday, or bearish engulfing bar, right? Higher than Tuesday, but closed below Tuesday's low. There are some signs of potential topping out there. The Russell, of course, already broke its uptrend off of the recent swing lows, although it does catch on its 1 month moving average today. On the way down, we rallied back into it, but never traded through it. This time, we're treating it as support. So there's good and bad in the price action. I'm more curious about some of the stories that have come out regarding what's going on in DC. In particular, Dylan, I want to talk a little bit about Freddie Mac and Fannie Mae, which are in the news again. Trump is exploring the sale of government-controlled mortgage giants Fannie Mae and Freddie Mac, which back about half of the $16 trillion U.S. mortgage market. These are probably names for most people that haven't showed up on their radar in recent memory. Bill Ackman's been talking about them since the end of last year. I know he took positions in them, predicated on the idea that the Trump administration might ultimately move forward with privatization, and it's been a very good trade for him. But if I may just explain what Fannie Mae and Freddie Mac are before we talk about the implications of this all, Dylan, I'm very curious in your take here because this has global financial crisis roots, of course. Fannie Mae was created in 1938 during the Great Depression to provide liquidity to the mortgage market. So this is a public sector response to the private sector housing credit collapse. Freddie Mac follows in 1970, essentially as a competitor, ensuring there's liquidity and reducing risk concentration. But the nuance is that in the late 1960s, the U.S. was dealing with fiscal pressure from the Vietnam War, from LBJ's Great Society program, and it needed to get Fannie's obligations off the federal balance sheet. And this is when privatization starts to begin. So in 1968, Fannie Mae is spun into a shareholder-owned publicly traded company, with the government keeping its ties through a congressional charter, which is important to note. Freddie Mac underwent a similar transformation in 1989, moving under shareholder ownership but maintaining the quasi-government status. Wall Street obviously loved these things because they have implied federal guarantees and they could borrow at lower rates thanks to these implied federal guarantees in their congressional charter. And lenders love them more. You could originate a loan, you could sell it to a GSE, and you could recycle the capital. So the privatization was never really clean. It was kind of a hybrid model, always was. Private profits, but public risk. So these were known as government-sponsored enterprises, GSEs, state-backed private companies with extraordinary market reach and benefits, including lighter regulatory treatment and tax exemptions. But when the housing market had exploded in 2008, so did this illusion of this being the perfect model, right? Both companies in Fannie Mae and Freddie Mac were massively over-leveraged and undercapitalized. The losses on subprime and Alt-A mortgages left them insolvent. The federal government had to step in at the time, placing both into conservatorship under the FHFA and injecting $191 billion in bailout capital. For all intents and purposes, they were now government-controlled entities, but still operating in limbo. They were neither fully public nor fully private. And since then, we've been stuck in a policy purgatory. Multiple administrations from Obama to Trump, to Biden, now back to Trump, have talked about different exit ramps from wind downs to recapitalizations to releases. Trump's been talking about ending conservatorship, which is what we've seen here now today. It's bringing this back into the foreground as an issue. I really can't remember a time in the past decade that we've had to have a serious conversation about the state of the U.S. housing market, mortgage origination, Fannie Mae, Freddie Mac. So, Dylan, I'm just hoping that you could talk to us a little bit about what happened, right? If all that, no, this was all the background, I think, for new people, right? Who
yeah, no, I get, no, for no, your summary was brilliant and obviously relevant. I mean, I think that to talk about these, anytime you talk about the U.S. housing market or U.S. mortgage lending or the U.S. banking sector, for that matter, J.P. Morgan, you kind of have to talk about it in two realities, which is there's one reality, which is all of this is a part of a broken system. A broken system because it facilitates an incredible amount of leverage that benefits a very small group of people and excludes a huge group of people from access to housing, access to banking, blah, blah, blah. Meanwhile, the people that are the CEO of Fannie, the CEO of Freddie, the senior mortgage trader at whatever, they collect fortunes, hundreds of millions of dollars, Bob Rubin, whoever, these people collect all this money pretending to administrate private financial institutions, whether it's banks or whether it's Fannie and Freddie, or the generation of people that own homes that that are now worth much more than they should be because the value of the entire U.S. housing stock is distorted by the underlying leverage in the financial institutions because of the collective and mutual self-interest of both the banks, the mortgage sponsoring entities, meaning Fannie and Freddie, as well as the homeowners. Everybody's kind of in on the con job, if you will, which then has left anybody who's not in on it out of it. So that leads to a broken political system, which gets you a double Trump and a senile Biden. And the reason I even bother talking about the non-trading, non-financial components of Fannie, Freddie, the other significant financial institutions in the mortgage market is not to sit on some sort of moral position at this point, but rather to suggest that the broken nature of the U.S. housing market that was highlighted as the core of leverage in 2008 and 9 is also the backbone of the Trump presidencies as an exploitation of the distrust and alienation in the have-not portion of charts like this, which represent all the things that I just described. With all of that said, from a trading perspective, particularly when you look at the Trump tax bill today, where I think he was talking about a tax deduction for car loans. What you have to understand about lending is that it's a product and it's a profitable product. And so, but you cannot make money lending if you don't have something to lend against. And so the reason housing is so spectacularly fabulous for the financial institutions is it serves as a massive swath of collateral against which there can be trillions and trillions, all this lending. The car market would be as a pittance in comparison, but you can see that they're trying to get in on that. So it's a tax deduction for your mortgage, or it's a tax, now they want tax deduction for your car, whatever. None of this exists. JP Morgan doesn't exist. This stock chart doesn't exist. None of these charts exist without the exploitation of the U.S. taxpayer. So the distortion is the idea that, oh, well, this is capitalism. This is successful enterprise and entrepreneurship that has led to prosperity and wealth for the genius entrepreneurs who have led the way. when really this is just this is a financial institution exploiting the U.S. taxpayer, or really not even exploiting, holding the U.S. taxpayer hostage, where it's like, either give me everything or I'll make your life where you can't have a mortgage. No one gets, either I get all the money or no one gets a house. And it's deals like that implicitly that have led to a double Trump presidency. If there's anybody who's going to allow Fannie and Freddie to uncork the way these charts obviously anticipate that they will be allowed to uncork, meaning that they will be unleashed from full government supervision and be able to function again as a private financial institution, but with the ultimate sort of too big to fail back end. So you can just, your only limitation is how much risk can you take, right? Like the value of Fannie and Freddie becomes a direct reflection of how many mortgages can you own, originate, have secondary, collect fees from, whatever. How much debt, how much housing debt can you have a relationship with that you collect money for it, with no regard for risk, because you get the false moral pretense of saying I'm supporting the housing market. Without me, no one can get a mortgage, so I'm doing a public good service. Meanwhile, I bear no risk, but I pay myself as if I was the world's greatest entrepreneur. That is like Donald Trump's bullseye, right? Like, if there's anybody who's going to let you pretend to be a billionaire entrepreneur while having no accountability, it's Donald Trump. I mean, that's his bread and butter. And so it makes sense to me that there would be a Fannie and Freddie would get unleashed at this moment. From a trading perspective, in other words, I guess that's a long-winded way of my saying I think it's more likely than ever that these companies will be let to go hog wild under Trump Act 2. From a trading perspective, when you look at these charts, I think you got to ask yourself what you're doing here, because obviously the market agrees with what I just said, which is that if there's anybody who's going to uncork these fellows, it's DJT.
Well, you can see that Freddie Mac is up 42% today. Fannie Mae was up 50.6%. I mean, Elliot, from a market structure standpoint, Fannie and Freddie represent perhaps the most consequential, fully unresolved issues of the post-global financial crisis era that's been swept under the rug all these years.
Yep.
I feel like everything, I mean, Dylan, maybe jog my memory, perhaps you'd know better than Elliot or I, but I'm trying to think of something else related to the global financial crisis that hasn't been resolved yet in some form or fashion. And this kind of feels like it's a loose end, and perhaps they're trying to tie it up. This seems like it's a little bit, it feels like it's a footnote in the news flow recently, but whenever a stock price moves 42 or 50.6%, you're going to have to ask yourself why. Mm-hmm. This feels like it's a core macro issue. I guess my question is, if we're thinking about trades coming out of this, there is a systematic implication here. If you're removing the two backstops for the mortgage market that are no longer government-sponsored enterprises, doesn't that put more risk on the balance sheets of private lenders like banks for mortgage originators? Doesn't it demand wider spreads? And I'm trying to think about what this means for home builders perhaps down the line, because on a day like today where we have this news of privatization, we actually have yields coming in across the board. Home builders are among the worst performers in the market. I couldn't help but notice that real estate struggles on a day like today when we have this Fannie and Freddie news. Is this another log in your fire to be bearish?
I mean, banks at this point do not generally hold the other side of the risk on consumer mortgages.
At all. They collect a fee and can call your friend.
Yeah, they basically, their job beyond originating this thing is really to send you emails or envelopes, depending on what your pleasure is,
all that,
with a logo on it, right? With marketing and your mortgage statement. They're just servicers at this point. That's different for let's say credit unions, which are smaller and which do still hold the other side a lot. But the larger financial institutions operate basically like this, and I'm no expert on the nitty-gritty of this space, but as I see it, from what is going on, they basically operate like this. They know what kind of a thing Fannie will buy from them so that it can securitize it, and so they originate mortgages on the basis of what Fannie will buy. And if Fannie won't buy it, they won't originate it, because the idea is that if you originate the mortgage today, by tomorrow Fannie already has it and the risk is off your books already, almost immediately. You basically create a situation where that's no longer the case, let's say, and banks have to figure out how they're going to take this risk if they're going to continue to provide mortgages. So, number one, you probably get less origination. The cost probably goes up, as in mortgage rates, because banks have to hold the other side now and be compensated for the risk versus handing it off right away. Now, obviously, these things don't happen in isolation, so we'll see how all of this shakes out with everything together. But on balance, this probably means that if you're a real estate developer, you're not so readily extrapolating that your inventory is going to fly off your shelves, as it were, because your proverbial shelves, talking about housing, because maybe you don't have the kind of backstop to mortgage origination that you had before. And that maybe is another sort of point of friction. We already see the point of friction that the 2022 Fed rate hikes were for the market. It drove both buyers and sellers out of the market, and the market is essentially frozen. This is why it sort of stubbornly won't come down. Even though we've had rate hikes, people don't want to sell. The inventory is 4-to-1 existing homes versus new homes. So there's woefully inadequate construction. And the people already sitting on mortgages that they locked in with an average rate, let's say around 4. I believe the average outstanding mortgage rate is somewhere even below 4 at this point. It's like 3.8 or something like that. But last I checked anyway, which was a few months back. So obviously those people look at much higher mortgage rates in the market now. They don't want to sell because they don't want to refinance to something new at a higher level. And that keeps prices up, keeps buyers out, keeps affordability out of reach. If you stop backstopping mortgage origination, you again have this other friction point where sellers don't want to sell because they're not sure what they'll get, how, and for what cost. Buyers are squeezed out, and you wonder when you get to a breaking point where you need to reduce prices to clear inventories. But it's unclear when that happens because housing is very slow, takes years, just by way of reference, right? We had a major housing crisis that precipitated the meltdown in 2008. Stocks already bottomed in the middle of March 2009. Housing wouldn't bottom until late 2011, early 2012, just because it takes forever for that market to roll over.
Like just a quick interlude here. The average outstanding mortgage rate in the country right now, according to the FHFA's dashboard, is now 4.3%.
It's gone up a little bit. So
it's gone up because the new origination over the past 6 months has been in the 6.5% to 7% range. So it's slowly dragging up the average right now. And last year it was like 3.9, 3.95.
There you go. That was about when I checked. That was about when I checked last. And in the heat of the Fed's rate hike cycle, it was like 3.6. So it made no sense at all. I mean, mortgage rates were surging, and you had a mortgage locked in at 3.6, 3.7. Where are you going? You're locked in for 30 years, stop it. You're going to avoid selling that thing under almost all circumstances because you don't want to then have to re-up at 2 times, 3 times the rate. So yeah, we've clearly crept up here a little, but we're still kind of hugging 4, and market rates are hugging 6.
I mean, 55, you can see it from this chart. This comes from the calculated risk Substack. About 55% of mortgages are 4% or under still, right? So, 70% are under 5%. And we're talking about, like I'm at 515. I'm not refinancing right now anytime soon. It's 200 basis points. What's the point?
Right.
And
so
like
this would create another point of the same kind.
Or moving for what it's
friction.
worth. Or moving for what it's worth.
Not that if you ask me, I would prefer never to move out of San Francisco ever, unless it, splinters off into the sea or some such thing. And even then, but
careful what you wish for.
You can never know. We are in a seismically active area here, and doomsayers keep saying that we're going to chip off one of these days and float in the direction of LA, which those of us in Northern California are just we're not prepared for that culture shock.
Dylan, I don't know if there's a trade here yet, right? But I looked to something like MBB, which is a mortgage-backed security ETF, and I scrolled through a bunch of them, a few of the tickers here on the platform. The big one is MBB, which is iShares. There's VMBS, SPMB. The total assets for MBB is only 38 million. VMBS is 14. So these aren't, we're not talking about huge products right now. But shorting these may be a long-term play. If what happens with Fannie Mae and Freddie Mac ultimately comes to fruition, if they are changed by congressional charter, although I got to tell you the way that this Congress has behaved, if Trump wants to do something that seems to be in Congress's purview, Congress is just letting him do it. So perhaps he just makes this announcement that they're going to look to sell this. There has been discussion, for what it's worth, that selling the stakes in Fannie Mae and Freddie Mac could be used to help pay down some debt or the deficit. I digress. In practice, privatization of Fannie Mae and Freddie Mac would mean fully removing them from federal conservatorship and allowing them to operate as an independent shareholder-owned financial institution with no implicit or explicit government guarantee. So that means they need to be recapitalized with private capital, which would be via public offerings, retained earnings, what have you, rewriting or removing their congressional charter. And then that kind of goes to the next question of where do we price risk if the government backstop goes away, which is really what my line of thinking is. Right now, markets are pricing GSE issued MBS if there's a de facto market, or rather de facto government guarantee, even though it's really never beneficial. So if we remove that by fully privatizing these, then one would have to assume that spreads are going to widen potentially significantly. You're going to need to have higher yields in MBS due to increased credit and liquidity risk. Investor risk premiums would have to rise, especially from institutions that currently treat agency MBS as effective sovereign grade. The U.S. Treasury yield curve may no longer serve as a tight anchor for mortgage pricing. Rating agencies would need to reevaluate the creditworthiness of GSE debt. Even if I personally don't care what those rating agencies think, I know a lot of other people do. And so without a federal backstop, their ratings would have to reflect the capital base, business risk, housing market exposure, no longer the political connections. So I could see a world where mortgage rates are going up, MBS demand becomes more volatile, banks, insurers, pension funds would have to then behave accordingly, which raises a final question of then who insures or steps in to insure a 30-year fixed mortgage rate if GSEs pull back. And I think that's the politically sensitive question, the most market important question, because the 30-year fixed mortgage is essentially a U.S.-specific product made viable by the GSE model. In a fully privatized system where you have private label securitizers, banks, REITs, hedge funds, they may step in, but they're probably going to demand higher returns without an implicit government backstop, so they're going to price their risk accordingly. You probably see mortgage rates rise, especially for lower income and non-prime borrowers. Access to longer-term fixed-rate loans could shrink in favor of adjustable rate or shorter term mortgages, which shifts risk back to the borrower. And to maintain affordability and access, I suppose, for the housing market, you still require government action, which probably would be a rebranded Ginnie Mae, subsidies, deregulation for housing, yada, yada. But this is a really significant piece of news that I don't think is getting the coverage that it needs, despite the fact that Fannie Mae and Freddie Mac are up 40, 50% today. This could be a more substantial issue long term. So if this goes through, I would just look at the chart for MBB, by the way, the highest liquid, biggest, largest assets under management mortgage-backed security ETF. It's barely sitting off of its April lows. Stocks have recovered. Bonds have not recovered. MBB is sitting near its lows. The lows that we had in last April, only near 89. We're currently trading at 91. Again, that July 18th expiry, I don't know, something a little bit further out, maybe going to, I would say even December, Dylan. We call this our madman trade for a reason.
I mean, I'm feeling like the layers. Every single thing you said sounded intelligent, rational, and, maybe even correct. But boy, you got a lot of layers on this cake, pal.
This is why, it's something to think about. I don't know if it's a great
trade. I like to
idea.
think of myself as a madman. And I do like a madman's delight, but even this one makes me a little nervous. There's a lot of assumptions.
Here's a simplification. If the upshot of all of this is it is more difficult for consumers to purchase housing because housing as a market has become locked in at higher costs for longer, because mortgage origination is harder, because rents
Stop
are
with the layering. Don't with the layer. You thought you were going to make it simpler.
Because rents are consequently higher. I mean, it's just more expensive. Everything becomes more expensive.
Okay.
In a consumer's
everything's
mix.
more expensive.
And what you need is consumers. And the thing you're losing, if we look at the first quarter data going to the second, is
sort
consumers.
Of MBB options trade or something. I don't even know what he's trying to get going on here.
I mean, this is just more fuel on the hold on, the Fed is about to get the recession it's waiting for.
I can see the non-housing where I can see in the sort of broader narrative discussion like where this goes, but I feel like Vecchio's trying to go straight into like the mortgage originations options trading world with that MBB thing, or what is this REZ? This thing is even liquid?
Smarter than
No. This isn't liquid enough, Dylan. Right? You wouldn't go over to REZ. This is the iShares Residential Multi-Sector ETF. No, I'm thinking about a long-term theme, right? Because we do need to do a check-in, and I want to do this next week after on the other side of Memorial Day. But I want to do a check-in on the Phase 2 AI names, which we brushed over, not so much recently thanks to the tariff news, but going back and revisiting the thesis and having, again, I like having North Stars for investing and trading, right? And this is something that's very important in my view for the housing market long term. So before we could have plays, Ilya, like, if the Fed, if we're done raising rates and the Fed thinks we're all in the clear and they're going to start lowering, this may help unclog the mortgage market and unclog the housing market. So home builders could finally unclench. And, what do we see in 2023 and 2024, right? Home builders have a pretty good run there in 2023 and 2024, right? Mm-hmm. This time around, if we get lower interest rates, but you're removing a government backstop to the mortgage market, I don't know if that means that lower rates automatically facilitate, there's a direct line straight through to higher profits for the home builders. Because, right? So home builders maybe lag a little bit more moving forward into the future. They're rate sensitive in the wrong way. They're going to suffer more under a higher rate regime. They're not going to get the benefit of the lower rate regime. So obviously there's nothing guaranteed right now. Dylan, should we put this trade on today? Well, the market's not open. It's an ETF trade. But the mortgage market would move once this becomes official, right? There are other dominoes that have to fall. So I'm not crazy about it, but I want to put a new theme on people's radar moving forward.
And the theme is houses cost more?
Housing market accessibility is going to get worse moving forward, which sounds outrageous because mortgage rates are at 7%. And for home affordability to return to the levels it was at just in 2019 at current income levels and current mortgage rates, house prices would have to fall 30%, according to Fannie Mae. Right? That was analysis that was put out at the end of last year. We've talked about it here on Overtime. The housing market's going to get worse. It's going to be much more difficult to obtain property if you're someone who's younger.
Housing market's going to get worse in the sense that prices are going to get lower, or worse in the sense that no one can get into the market if you're not already there? Because it's a two bifurcated universe, basically.
It's getting more. It's going to be more bifurcated moving forward. Maybe that's the actionable piece of information here. Get a house while you can, and if you have one, hold on to it for dear life. It just seems like something's going to break as a result of this. Just my 2 cents to give us something different to talk about, because we've talked about tariffs and Trump and Elon Musk and everything else.
I mean, I think it's interesting. I listen and look at those Fannie. See, don't you think that Fannie and Freddie chart is also probably a way to enrich Trump adjacent individuals?
Look, Bill Ackman was talking about this in the fall, and he's been a proponent and a supporter of the administration. And so it wouldn't surprise me if he planted a bug in someone's ear. You guys should consider this as a policy. And yeah, it so happens to benefit me, but I think it's a good policy regardless. That wouldn't be untoward. I mean, maybe it's untoward, but it wouldn't be unheard of for someone to have that conversation. Right?
Of course. Well, that is what politics and money do.
And we have First Buddy Capital running, and as is so curious, a lot of Elon Musk, the investigations into his companies disappeared.
But let's just go down. Let's go down your layers of layering, and assume that mortgage rates are higher. Right, that's one of the assumptions in the layer cake. Correct.
Yeah.
And that basically mortgage origination, that it's just harder to get a mortgage, and that then whatever mortgage you get costs more. Fair.
Mm-hmm. Yes.
Doesn't that make housing prices go down? And like, if you're going to have harder to access mortgages at higher rates, and you're going to have higher rates in general, doesn't that beyond housing create a weaker jobs market, a lower gross margins, less free cash flow, all the sort of Ilya-isms? Mm-hmm. Are also true if the housing story is true, by definition, the other story is true times a billion. But doesn't that ultimately result in lower housing prices, and lower rents? Or are you suggesting that these higher costs, that the higher cost basis gets laid across the whole thing? At the same time, house values and rental pricing does not compress.
Yeah, I think that's the outcome. I don't think house price, unless you see a gigantic build, right? Like, why are rents falling in Austin, Texas? Because they're just building so much damn housing. Like, unless we get into that world where we just build and build and build and build, which I would love, not because of any particular financial reason, but because I think that we just don't have enough housing in this country in the right places. And that's why people are being squeezed out. So solution to the problem where there's too much demand and not enough supply. Add more supply, right? The demand is.
Well, what about the European solution, which is just eliminate leverage, max cap leverage to buy a house at 2-to-1?
Problem with the European solution is you don't have, because of, by the way, the kind of issues.
Well, it's impossible at this point, but anyway, yes.
Yeah, that you might get here is these mortgages in Europe. Like, there's no such thing as a 30-year fixed mortgage.
I'm well aware,
and costs become much more fungible.
Well, not only that, but there's nothing like buying a piece of real estate with 5%, 2%, even 10% down doesn't exist. But it's also why housing is not such even in the most expensive cities in Europe, $2 million gets you a fabulous mansion of sorts, whereas the same $2 million in an American city gets you, a closet. And the only difference between those two worlds is one is a 5% down payment with a mortgage, and the other one is a 50% payment with 50% in some sort of a loan from a non-traditional, like not a loan that would not be a mortgage in the traditional sense of the
U.S. sense. Yeah, I mean, I don't think, and Chris, correct me if I'm wrong here, I don't know what other country has 30-year fixed as a thing, or certainly as a thing that is as prevalent. I mean, at this point, most U.S. mortgages are 30-year
and it's the most
fixed.
distorting force in the U.S. housing market and the greatest opportunity for financial leverage and malpractice.
Germany
and
has...
also a tremendous opportunity for wealth building, consumption, and economic growth. So there's two sides of this coin. If the economy is powered 69% by consumption, that you let consumers lock in housing costs for 30 years
with a ton of leverage,
and I mean, increasingly 20% is what's normal, and below 20 doesn't exist in practice. But still, I mean, in Europe, to your point, you're talking about 50. So other places, again, much higher.
There's like 8 countries on the planet that offer something like a long-term fixer. The U.S. does, which has the highest standard. Germany has some available up to 30, but again, it's like fixed rates for the first 10 or 15 years, then adjusts. Right. Same thing in Canada. You can get a 30-year mortgage, but their fixed rates are 5 years, and it's on a 25-year amortization schedule. France does have 20 and 25. They do have 30, but you have to be under a certain age. Japan has flat 35, but that's it. It's Germany, Switzerland, Sweden, Canada, Japan, France, Denmark, and the U.S.
And floating rates are not, and they're not floating rates are the norm there.
Yeah, and but usually they're tied to LIBOR or some short-term adjustable rate that resets every few years. So I'm going to borrow for you for 30 years, and in 5 years my rate's going to reset, and then in 10 years it's going to reset again, and in 15 years it's going to reset again. But I have access to this, pool for 30, right? So it's the housing markets in these other countries. Just they're not as important, Dylan, because we don't have 80, 90, 100 years of these GSEs into the system, right? Originate when? The New Deal. So going back to a world where you're in a pre-New Deal housing market, dare I say? I know a lot has changed since then.
I mean, that's not fair. That's not going to happen.
That's not a fair characterization, but that's.
But your point is that the probable path is a worse, a lousier housing market condition in terms of accessibility by virtue of both cost of the debt, accessibility of the debt, and entry price points. Every variable gets more inaccessible.
Imagine you're playing a game of musical chairs. This is something that just put the chairs up on a hill. So not only do you have to go scramble to get a chair when the music stops, you're going to have to run uphill to get to that chair. Mm-hmm. And so if you're already sitting in a chair, you're on the plateau. When the music starts going again, you're already up there to start running around. This is this is going to fundamentally disadvantage people who are already fundamentally disadvantaged to accessing the housing market, in my view. So it's a theme that we should pay attention to. This is going to require congressional approval, ultimately, if it's really going to change, because Trump's going to wave his hand, then Democrats will sue him, and the federal courts will say no, and then Trump will tweet out that activist judges are stopping him, and then he'll go to Congress, and they'll really do it if they want to do it. But it has been raised by Republicans as something to help pay down debt, to help offset some of the costs of recent spending. It was floated today by the Trump administration. It's one of, I can't think of others, Dylan. I'm thinking of loose ends from the global financial crisis, and Fannie Mae and Freddie Mac being in limbo is perhaps the most consequential one that's been left unresolved. So it piques my interest and what its implications would be, because it just hasn't been on anyone's radar really as something we should be talking about or considering for a long time.
Yep.
We are almost at the end of the show here, at the end of the week. This was a quiet week for the most part, dare I say, for macro data, there were some interesting things that came out for earnings. Home Depot, Lowe's. We saw news that Apple, Tesla, and NVIDIA shares are going to trade as digital tokens on Kraken, which I think is interesting. There was also a G7 announcement to address global economic imbalances. Ilya, this seemed like a way to indirectly criticize China's trade practices without explicitly naming China.
Yeah.
Is this the G7's attempt to get on same page with the Trump administration? We talk about Chinese dumping, not enough domestic consumption, too much manufacturing, excess.
I mean, in this sense, Europe has been on the same page with the Trump administration since the first Trump administration. There is general consensus that China is engaging in practices not in the spirit of their admittance into the World Trade Organization. And this has been a consensus view really going back to the Obama administration. Because if you think about what the TPP, the Trans-Pacific Partnership that ultimately Obama didn't land at the end, he got the agreement but couldn't get it through legislature and couldn't get it actually signed. What the object of this was to box out China. It was a trade agreement with all of the principles that move goods through the Pacific, be it Australia, New Zealand, or Canada, or the Latin American countries, all of ASEAN, Japan, Korea, Taiwan. It was an agreement with us and all of those countries that pointedly excluded China and said, all of us here in the China sphere of influence, we're all going to write the rules of the road, and you all have to be essentially price takers because you can't not do business with all of us. And we're all going to harmonize. Then, of course, the Trump administration killed that, and so we now have to find ways to continue to counter China. But this was consensus for a long time. I mean, we see what happened with EV exports most recently. Europe basically matched the same kind of barriers that the U.S. put up against the dumping of Chinese EVs and all manner of other Chinese dumping also. So this is not unusual. This does put Europe on the same sort of footing as the U.S. to some extent. It doesn't kind of really make things any better for Europe because the tighter the U.S. squeezes China, the more pressure there is for China to dump things on other markets, including Europe, and other markets are resisting to some extent. So you are in a place where ultimately sort of the upshot of all of this, and if you're curious, there's a wonderful little vignette on the Wall Street Journal's YouTube channel about a little manufacturer of puzzles based in Brooklyn that makes little quirky little puzzles, and their supply chain is China. And of course, with the tariffs, they are trying to move manufacturing, reshore it, as it were, to the United States, and can't. Not because they don't want to pay a little more, because the kind of manufacturing they need to make their little cardboard puzzles, from design to printing to the inks to the materials to the packaging, it just doesn't exist.
Oh no,
and won't.
I've run into that problem trying to build things here. Like we don't make the machines to make the stuff, so you have to order the machine that makes the machine from China.
Right. And so they're talking about, look, maybe we'll order the machines to make the stuff, which can be had in Europe, but they're very expensive, and we need to know that we're going to be able to do this with a 5-year window, 6-year window, so that we can justify taking on this expense because our business is going to survive that long because of all the ostensible reshoring. What all of this fundamentally does, and what this sort of example illustrates, is that the release valve on the deglobalization thing that we're going through now is just higher costs and weaker growth. This is the stagflation that the Fed is worried about, that Jamie Dimon is worried about, because the harder we tiff with China, the more dumping there is on other markets, the more those markets raise trade barriers, the more overall commerce becomes expensive, the more demand is weakened, the more stagflation you get everywhere.
Well, we're going to have to address those
And with that,
tomorrow.
And with that, overtime is out of time.
And with that, with stagflation everywhere, we are out of time.
We'll be
Sorry.
back next Monday, same time, same place, 4 p.m. Eastern, right after last call. So for Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris Vecchio in New York. Good luck trading the rest of tomorrow, of course, to end the week. Monday, we actually have Memorial Day, so we're not going to be here. See you on Tuesday. Hope you have a nice weekend. Up next, Ilya Spivak with Macro Money.
See you there, everybody.
Dear Cheapo Airlines, thank you so much for sending my luggage on a magical side quest instead of my planned destination. I am glad that I had the sustenance of the single pretzel I was served on board while I was waiting for my bag to arrive. Looking forward to your reply, because surely the response can't be as delayed as long as my flight was. Warm regards, Bettina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
Every day I do God's work here.
From the smart mouths at tastylive.
I want to play a game. It's a relationship game. So I'm going to ask you each a question.
Who loves the hardest?
Yes, yes, yes. So are you ready?
TikTok game.
Who's more stubborn? Who's more public? Who's more patient?
These are two of the least. These are the least patient people I've ever met.
I'm going to say him just because he's a little older than me.
Who calls or texts more? And who do you think takes longer to get ready in the morning? Who's a better driver?
I drove a truck in New York City.
I can fly an airplane.
Who loves the Fed the most? Who's the bigger spender, do you think?
Me. Yeah.
Who's the alpha in this relationship? Who is more spoiled?
Oh, him.
Who do you think is funnier? Who is the better debater?
I'm gonna give it to him.
Dylan, you think you're the better debater? Are you the master debater?
No, he's he's good because he doesn't answer the questions, which is great for debating.
Diversify your portfolio with stocks, options, futures, crypto, and more. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Tasty Trade. Download today.
All right, Mike. All right, Nick. Do you remember the first trade that you ever made in your life or in your career?
I do. It was a long call on Twitter. This is when it was a publicly traded company. It was at like $50 a share. I bought a call at 50, and the next day it rallied, I think, 11%. And it was like the single largest bull rally in one day in Twitter. And I was like, this is the easiest thing I've ever done.
Oh, I know the exact trade. So it was in Costco. I don't know the exact strike, but Costco was trading about 150-ish. This is in 2015. I sold, I believe, the 165 strike call against it because I read some article online that Walmart was going to eat their lunch. Costco, I think, went from 150 to 200 within 3 weeks of that trade. It was a massive, massive losing trade. I learned a lot from that trade.
And you still came back?
I still came back. Yeah. I was not discouraged. I thought I was an idiot, but I was not discouraged.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number 1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
So I studied economics and international relations, and I wanted to do the hands-on rather than the academic version of that, and the most natural thing was global macro investing. I begin with a sense of where I think the overall direction is for the macro theme for the next 6 to 12 months, and then look at some basic response from the price action to see how it's going. I think the price itself is the purest of indicator. It subsumes within it the collective emotions of the market. One of my favorite mottos, if you will, comes from the always great Ira Harris, who said, if you're right at the wrong time, you're wrong. And so, for me, every macro narrative begins with what's the price action saying, rather than this or that economic indicator or some such thing.
Markets managed to find a little bit of a reprieve. Perhaps they might have found more. Looking at the U.S. economic calendar today, we finally get a little bit of economic news to chew on, and it's a little bit brighter than expected, at least at first blush. So why the reticence? What can we expect from here? That's what we're going to tackle on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And we are going to set ourselves up here for a little bit of a Fed policy speech over the weekend by unpacking what is, at surface level at least, looking like a little bit better economic data out of the U.S. and a little bit of a step back from the extremes that we saw in April. Maybe. Then see if perhaps what we then hear from the Fed might be encouraging, or if in fact we are in a situation where the market's reticence is telling us that the backdrop here is becoming somewhat undigestible, regardless of what the central bank might do or not do near term. So let's pull apart here what this data gave us and see if we can, in fact, hang some optimism on it. This is the full breakdown over the release schedule overnight, and we can see here that what we have is Purchasing Manager Index data for May from across some of the major economies, and I've highlighted the composite figures here to kind of get a sense of overall growth, taking in both manufacturing and services in these major economies. As ever, this data is done around a center line of 50, where 50 is neutral, above 50 is growth. In this case, economic sector activity growth, So if you get a, let's say, manufacturing reading above 50, what that means is the manufacturing sector is growing. Economic activity in manufacturing is growing. If you get a reading below 50, that's contraction. So economic activity in the sector is contracting. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So as we go down the list here, we can see signs of weakening performance globally until you get to the US. So in Australia, the composite index pointing to slower growth versus the prior month. Although you still have growth, you're near standstill. In Japan, you've gone from growth into contraction mode. In the euro area, you've gone from very modest, sort of standstill-like growth to contraction mode. Notably, this is worse than expected. In the UK, same thing, contraction mode for another month, albeit the pace of contraction eases a little bit, so you go from 48.5 to 49.4. But then you get to these US numbers, and here the expectations were pointing to ongoing standstill after the preceding months. Standstill in manufacturing, standstill in services, holding basically within a hair of 50. What you got were numbers that were significantly more encouraging, it would seem. So 52 and change here across the board, suggesting that growth rebounded in May after what was a very difficult month of April, which we can see here gave us some of the weakest growth that we'd seen out of the U.S. in 19 months. So ostensibly, this is good news. We've talked a lot about the idea that the global economy is basically powered by three growth engines: the U.S., the Eurozone, and China, which collectively make up 58% of global GDP. The remaining 42% are mainly vendors to the former three. So think Mexico and Canada in the U.S., or the commodity producers in Southeast Asia or Latin America or Africa or Australia, for that matter, and China. Think about Central Europe, Nordic Europe when it comes to the Eurozone. So there is a very significant amount of weight on just three economies to really be the source of demand that powers things. And of course, China, in its kind of spot in the middle of the global supply chain, is itself dependent mainly on demand from the US, but also, of course, the Eurozone. And so those are kind of end demand markets. And so what's particularly interesting about this PMI data set, of course, is that we got updates on where US and Eurozone economic growth sits. And that's after, in the April month of surveys, it was a 17-year low on global growth. And that 17-year low came as the US basically ran out of capacity to offset weakness elsewhere. The story of last year really was that growth in both the Eurozone and in China ground to essentially a halt. Meanwhile, the US was powering on because of a strong service sector. And in the US, the service sector is mainly serviced by domestic demand. And so that strength in the US didn't very much spill over. Most of what happens cross-border, most of the way that US demand spills out across borders is trade. Most imports are of goods, not of services. So you have a situation here then where the story really since the middle of last year, since right about here, was that the U.S. is having a boom, and that's keeping overall global growth at least somewhat positive. You can see that right here. It's basically keeping it anchored, although it's drifting a bit lower. But it's not until the beginning of this year that you get this sharp push down and you hit 17-month lows in April, as though the whole thing is starting to unravel. And that happens, if you look at the U.S. set of PMI numbers here, as the U.S. service sector cools and activity slows. And you can see here, this is the May set of numbers. They're unquestionably better than the April set of numbers. That much certainly seems to be the case. Growth has accelerated. But it's still very much on this downside trajectory whereby it's catching up downward on Europe and the situation in China. And we can see here in Europe, even this somewhat moderating story where manufacturing is shrinking at a slower rate, you still have a sharp fall back in the composite because the service sector falls into contraction territory as well. In fact, what we have here for the Eurozone is really quite shocking, really. We have the weakest service sector growth in Europe since January of 2024. So we're going back over here. And this was something of a kind of mild recession at the in the Eurozone in the tail end of 2023. So of the main engines here, this one continues to look weak and is in fact looking weaker. This one is to some extent still dependent on demand from these two, and mainly the U.S. And so in seeing these U.S. numbers, you kind of get the sense, okay, well, the linchpin didn't give way in May. But then you look at the internals of this report, and it starts to give you a little bit more of a sobering perspective. So first and foremost, the growth that you see in the numbers here seems to again amount to tariff front running. We can see here an absolute surge in stocks of purchases, that is to say inventories. So there is a massive restocking effort that seems to be underway. In fact, taken together, both manufacturing and services, you have the biggest inventory surge since the PMI data on this score begins 18 years ago. And that, understandably, if you read the details of the report here, speaks to the tariff cliffhanger that comes in early July and then again in early August, when reciprocal tariffs above 10% start to be a risk again, the 90-day reprieve that keeps them at the 10% level expires for most economies in early July. And then for China, they're looking at a 30% tariff, but the reciprocal floor is 10, and then there's some extras there for punitive tariffs around the fentanyl trade and things like this. So the effective tariff is 30%, but that reprieve on the reciprocal tariffs above 10 for China, that expires in August. So there's cliffhangers here coming up, and much as we've seen before, businesses are stockpiling rapidly to try to front run that. Moreover, bottlenecks have become more acute. We can see here the delivery times scale. So this would be delivery times declining. This would be delivery times going up, because, of course, this is an inverted sort of thing. And, of course, delivery times lengthening or shortening, somewhat of a different scale on the 0 to 100 and around 50 measure. So what you find here is that delivery times have lengthened considerably. In fact, you're going back to kind of the middle of 2022 for a reference point, maybe a little bit later, like September, October of 2022. And that speaks not only to tariff barriers, but also to this rush to restock. But then on the inflation side, and this is for both manufacturing and services, you see an absolute surge in costs. In fact, since the restocking is most aggressive on the manufacturing side, not surprisingly, this is where the cost pressure is greatest. Moreover, you can see that the difference between input and output prices is narrowing, in the sense that output prices are surging, which tells you that businesses are passing the costs on down the supply chain. So massive inflation here. In fact, the indication is that you're looking at price growth unseen since August of 2022, which is about a month or two, depending on which indicator you look at, removed from the post-COVID peak. CPI, for example, peaks in June of 2022. Before then, it starts to succumb to the Fed's rate hike efforts and comes down. So, and of course, supply chains get mended, and there's a constellation of factors there. So the upshot here is, yes, there appears to be more economic activity, but that economic activity appears to be fueled by something inherently temporary, the front running of tariffs ahead of another policy cliffhanger. Moreover, what you have is a surge in prices because the entire sort of act of trade has become more difficult and more expensive. And both sectors, services and manufacturing, end up cutting jobs. That is to say, they're not expecting this surge in activity to extrapolate forward. They're not looking at this as something that begins a revival of demand. So this is inherently something that is driven by a policy risk rather than by expectations for consumer uptake, or at least certainly there's hope for that uptake here, but it doesn't say anything about that uptake being there. And in this, it makes it look very much like the first quarter, where, of course, we saw a surge in imports, a surge in inventories, but consumption was actually the weakest it had been in almost 2 years, going back to the second quarter of 2023. And if we look at what matters for GDP growth, it is consumption. Consumption is 68.5% of overall GDP. Looking at the components for both inventories, which fall into non-residential investment, as well as for imports and exports, and you net those out to get the impact on GDP, you're looking at a pittance. In fact, the trade component is less than 5% of the whole thing when you net it out, as compared to almost 70% for consumption. And so you get this sense that businesses are building these inventories. They're trying to front run the tariffs. They're straining supply chains and fueling inflation. But there's no guarantee that consumers are coming to buy this stuff, which is what you'd need to actually grow the economy. You see in the numbers that we've seen so far leading into the second quarter, weak retail sales. You saw the front running in March. You don't see it in the subsequent April report. So going into the second quarter, you already see that consumers are defensive, despite the fact that businesses are being goaded to front run. Consumers are holding back. That's despite the fact that goods inflation really didn't surge in the April numbers, as many people feared. And the reason it didn't, even though we can see here that at the wholesale level, this is the PPI data now, they jumped to some of the highest levels since early 2023, we can see that businesses ate those gains and took the hit on margins. That this is the drop here in the PPI for trade services, which is a sharp 1.6% squeeze on margins, and basically told you that businesses ate the extra costs for consumers. That would be these extra costs right here. We can already see, obviously, going into May that costs were on the rise. So those extra costs get eaten by businesses and consumers still don't come. Moreover, consumer confidence sinks to levels unseen since the lows post-COVID, and inflation expectations surge way above levels that the COVID peaks had it, as far as consumers' one-year inflation expectations. So consumers are, by all measures, very gloomy and reluctant to spend. That they're expecting prices to be this much higher ought to be a magnet to spend now, one would think. That there is a cliffhanger on these tariffs might be a reason to spend, to front-run them, much as businesses are. But that is not what we are seeing here. And so you arrive at a situation then where businesses are building all these inventories, but perhaps there is no one to do the buying. And without that, there is no economic growth. So yes, at the headline, it seems like these numbers push back on stagflation risk this month, in the sense that the inflation is there, but the stagnation maybe isn't quite so quick to come. But under the surface, what you see is a recipe for sharper stagflation downwind. And so, as consumers are essentially driven away, despite what stockpiling occurs, and then perhaps eventually you get to a point where the inflation side of this craters under weak demand, which is, of course, exactly where you have the Federal Reserve step in. We have a speech this weekend from Fed Chair Jerome Powell. Against this backdrop, he seems unlikely to give the markets any more clarity, and they've reduced rate cut expectations now to just 89 basis points over this year and next. That's about 50 basis points this year, 50 basis points next, almost in line with Fed expectations, a little bit less dovish. The Fed sees a full 100 basis points, and the markets are almost there. So you can basically say that we're in a kind of holding pattern here. But what all of this suggests together, if Powell confirms as much, is that the Fed is going to have to wait for the brutality of the economic downturn to really hit inflation hard enough that it can cut to support growth without worrying that it will unmoor inflation expectations, which means waiting longer. And of course, what that makes for is a tolerance for more of a growth downturn. We see something very similar from other central banks this week. And of course, what that means is perhaps stocks are not confused in their soggy response in the face of today's data after yesterday's sell-off. They ultimately pause to consider and don't make much headway. We'll see how markets open next week. We have a holiday shortened week with Memorial Day, but the internals and the components of what's shaping up here are not nearly as rosy as would seem at first glance, and the markets appear to be wise to it. And this is Macro Money for today. As ever, we are here right after overtime. Show I co-host with Dylan Radigan and Chris Vecchio Monday through Thursday. I'll be back for Futures Power Hour with Chris tomorrow, as I am every Friday. I'm also on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call, although not next week on Sundays, usually on Sundays, but we have the holiday, of course. I'm also writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Thanks very much for watching. Macro Money is back next week. Happy trading.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
So you're an active trader, looking to increase your return, decrease your risk, or quite possibly both. Sure, you've heard of the Greeks. You know, your deltas, your thetas, your vegas, your charms, your vamas, etc. And you're wondering, hey, how do I use these guys to improve my risk-return relationship? Well, join me for a 10-episode crash course, and I'll show you exactly how to do it with all the gimmies and gotchas, one Greek at a time. We'll see you there.
tastylive's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
What is going on, everybody, and welcome back to Risk and Reward of the Week. Today is Thursday, second day of the week of this show. Tuesday, we did put on another risk. We'll give a little bit of an update on that today, but we'll go over all those things. But today, we're going to be touching a little bit on Bitcoin. What is the relevance of Bitcoin? Is this still some buzz? Is anything going to happen here in this crypto space? I feel like it's just buzz, but we'll get into that today. Before we do that, Gus, what's going on, brother?
Doing well. Hanging in. Long delta in the portfolio. So it's, as we've slowed down a little bit here, it's been a little bit rough on me. I did blindly get long VIX yesterday. That panned out for me. So happy on that one. But yeah, doing well, hanging in. Little bit tired today myself. I won't lie to you. I've had more caffeine than one should. It has not helped, but I'm here. I'm dialed. I'm going to use the rest of the energy I have in the next 30 minutes.
I love that. Are you a caffeine in the morning kind of guy? So I just say that because I was never like a caffeine in the morning. And then there was a week where I started to have a coffee or a Celsius in the morning at around 7, 8 a.m., getting ready for the market open, those kind of things. And I felt great. And then I was like, I feel a little bit too good because now this is going to be a habit if I continue this, because this is kind of nice. Are you a caffeine in the morning? Where is your stance on coffee? How do you intake your caffeine?
Yeah, I certainly am. I have a coffee every day here in the office, but in the morning I actually just take a pill. I just take a 100 milligram caffeine pill with breakfast. I find that to be the most efficient route. I don't like making coffee at home. I don't want to, get a coffee on the way to work every day or be, dragging myself in here and groggy until I can get one. I have switched to the caffeine pills, and honestly, I like it more than any caffeine drink I've ever discovered. It's I find it's, faster acting, and it's also slower releasing. It's more like sustained energy rather than like I don't feel the fall off when it happens at the end. I have a lot of caffeine on a daily basis. 100 milligrams there, another cup of coffee when I get to work. Sometimes a Red Bull in the afternoon, pre-workout. My pre-workout I have a caffeine free and a caffeinated pre-workout, so I can choose what I want to do there.
That's kind of nice. You're like,
I'm a
forget the
caffeine
enthusiast. No, I forget the coffee, forget the drink. I'm here for the literal caffeine. That's all I need.
No, for real.
I hear you. We'll get into these slides. We can start pulling the slides up here. But what a game last night. I mean, Pacers and Knicks. What a shot by Halliburton. Risky celebration at the end for it to be a 2. But we'll get into the slides here Did you get to watch the game? Did you catch it at all?
I did, yeah. I actually watched the hockey game first, and then I shot over to the basketball game like halfway through the fourth quarter. So I caught basically the best parts of it, the entire Pacers comeback and that crazy shot at the end. Overtime was wild. The Knicks had 3 looks to tie it back up right at the end and couldn't convert, air balls and bricks. It was crazy.
No, it was insane. I wasn't giving enough respect to the East. But after seeing some more games, I think that's going to get me a little bit more engaged on the teams on the East, because now it's like, oh, yo, this is a great. This might end up being a great series. So, New York Knicks is a big market team anyway, so it's kind of cool to see a lot of attention on Madison Square Garden.
Yeah, but, to everybody in the comments here concerned about my caffeine. Also, I appreciate the Cornholio reference. I know Beavis and Butthead. I know what's going on, but it is. I stay under 300 milligrams a day. That's my daily cutoff. I do keep track of it and make sure that it's not affecting my cardiovascular health too crazy. The studies say that I can have about 400 before it starts to get dangerous. So I'm well clear of that threshold. Yeah. I had to do my research when I realized I was doing like 250 a day on an average day. I was like, man, is this unhealthy?
Isn't there a limit that they can give you as a barista?
I don't think so, because Panera had that thing with the charged lemonades, and I think if there was a limit, that would have been over.
That would have exceeded it.
Panera was killing people with those things.
Oh yeah, that was getting people jacked up. That's funny. As we get into our segment for today, guys, it's going to be how pizza proved Bitcoin works. Some of us may have heard this story before, but it really just showcases that there might be a legitimate use case in Bitcoin. So let's kind of get into what it is, why there is even buzz around Bitcoin, and what solutions Bitcoin provides to society as to why it has so much attention. So let's get into that. But in 2010, 10,000 Bitcoin bought 2 pizzas. Can you believe that? 2 pizzas. And today that moment marks the start of Bitcoin's real world journey and a revolution in digital money. Real world in the sense of it was the first time people saw the use case for Bitcoin and it wasn't all talk. So I'm gonna get into it, but I got to ask Gus, I remember the first time I seen Bitcoin, I was in middle school. It was called Jag News. My school was called the Janitel Jaguars. So at the end of the day, we had an advisory period and had like a 15-minute news segment, but it was very specific for like middle schoolers or like high schoolers. It was like that type of network. And it was the first time I even heard about cryptocurrency and that you could purchase things with these things. So at that time, it was such a new thing. And, people would ask, do you believe in this? Do you think this is going to come to fruition? Do you think this will have mass adoption? And at that time, it was just like, worse, it was a bigger idea than purchasing something online with your credit card at that time. So it's just crazy to see now it come to fruition and it be a legitimate industry. So I don't know when the first time you heard of Bitcoin, but what was your perception of it?
Well, you were at a pretty advanced middle school if they were giving you guys Bitcoin in the school news. What year would that even be? Like 2012?
Well, that's what it was 2012. It was exactly 2012. I believe I was in 7th grade, but it was just one of those ideas. It was like, insane idea, but we have electronic currency, and that was like an insane idea. Like, what is that? Will this even, and you kind of just brush it under the rug, and then 10 years later, you're like, what the hell is going on? This thing's legitimate. So
yeah, for me, my perception kind of just forever was that Bitcoin is that thing criminals use to like get ransom. Like that was the only capacity I ever really heard about Bitcoin in for a long, long time. And then I do remember pretty vividly, I guess when I was like 16, I would say like 2016, 17, like when the initial Bitcoin pump kind of happened and it became like a more mainstream financial asset and something that people actually trusted a little bit more. I believe that was 2016, 2017. We're going to get into a timeline here shortly. But that was the first time. I do have a pretty clear memory of I was going to pick up my girlfriend at the time, and I was a new driver. It was an exciting time of life, and and I remember seeing a headline that Bitcoin had exploded, and I was like, Bitcoin, like that, that weird fringe thing that people talk about that the criminals use. Like it was very strange to see it move up like that. And that's, I think that's the perception that is shared by lots of people who weren't plugged into the crypto space, in the 2000s and the early 2010s, was that you'd only ever hear about Bitcoin when some, criminal would demand 300,000 Bitcoins for XYZ. And so, it was interesting to me when it all of a sudden got legitimized by the market.
That makes a lot of sense, though, because that first perception makes a lot of sense, because you would initially think, why would I even use why would I not just use Zelle or PayPal or use real USD cash? So it's like, if I'm using Bitcoin, it must be for another reason that might not be so legitimate. So maybe that's where the thought process took you, but that's an interesting take. You're right. At first, I was thinking maybe it's the word crypto. It sounds so cryptic, you know what I mean? But like maybe it was just the case of, why wouldn't I just use USD? Why would I even use Bitcoin? So
Someone in chat said all I knew was Silk Road and that's it. Yeah, I think that's a pretty common thing.
Pretty much.
That's what the drug dealers were using. Sorry, go on.
No, yeah, absolutely. But as we see here, 2015, 2017, like you kind of just mentioned, crypto became a little bit more mainstream. That's when it really popped off. And it's like, oh, yo, this thing is popping off and kind of holding its value. Thereafter, going into a little bit of a bear market. But why May 22nd even matters, and this is celebrated globally, depending on who you ask, as Bitcoin Pizza Day. And like we just talked about, it's a symbol of Bitcoin's transaction from theory to use case. I kind of have the same perception of Ethereum, actually. I know like all those NFTs popped off, but I kind of had the same questions for Ethereum. It was like, what is the use case for this? And then after 2020, all the NFT projects started popping off. So it's like, okay, I see, NFTs built on the blockchain. I see the use case for Ethereum, and this pizza being purchased here, 2 of these pizzas being purchased, was like the first time, the industry really saw a real life use case for something like Bitcoin. So it just highlights how early adopters really shaped the crypto history. But the first transaction was, again, May 22nd. That was worth $41 today, over $1 billion. So that $41 of crypto that was purchased for those 2 pizzas is now worth over $1 billion. And this marks the first real world use of the Bitcoin currency. So, I mean, I don't know, maybe it was one of those things where it was like, I have this crypto that's like less than a penny or whatever it cost at that time. And it's like, this will be cool to purchase something with. I don't know if you remember Kay, but Kay was on the Where Do I Start series. And she was a little bit more into a lot of the NFTs and the crypto and things like that. And I remember she had made a post on Twitter and it was about Dogecoin when Dogecoin was really popping off. And what is his name? Dallas Mavericks ex-owner. Mark Cuban. Yeah. So Mark Cuban had a reply to one of her posts talking about, yo, if you want to spend your Doge, like this is when Doge is all over the headlines. And he replied to her on Twitter, like, yo, message me if you come out to one of the games out here. I would love to see how you're facilitating like the Doge transaction. Like, let's do this. He was probably trying to make a play on like showing the utility of Doge. But anyways, whenever Doge came by, it's like, okay, yeah, I'll buy some of these Mavericks. I'll buy some of the Maverick merch because I just want to see the transaction of Doge. But if Doge ends up coming to be a big player like Bitcoin one day, which it probably won't, but if it did, you'd be like, or Kay might be like, yo, I cannot believe I purchased these tickets or I purchased this merchandise using Doge. But it was probably one of those things. You didn't think Bitcoin would come to fruition, and years later, you recognize your pizza is now $1 billion pizza. So I don't know how you might have felt about that. You're in that situation, guys.
Yeah, I think that it's interesting. I mean, I think that this pizza transaction was certainly just for the novelty and wanting to be able to spend these Bitcoins on something. I've read a similar story that happened maybe 4 or 5 years after this one, where Bitcoin had gone to, I think, 1,000, and a guy used it to, he had made like insane gains, and he used it to buy an apartment in New York, or a condo in New York City. And it's like now you're in a $100 billion condo or whatever it would wind up being. But yeah, I don't know. I think that it's interesting. I have more points to give on this topic on a slide that's going to come up later. So I don't want to get into it too much. It'll be slide 4. I have some things to say.
All right, we got it. Why does Bitcoin even matter though? Is my question here.
It's a good freaking question, man. No, it's so Bitcoin, it acts as a currency, which is interesting. There's 3 criteria for a currency. It's store of value, medium of exchange. Third one escaping me. Chat can help me there. But it allows for a store of value outside of banks, and for a while to a serious degree, and now to a lesser degree, but still true, less tracking, less regulation, less oversight on what you're doing with your money, which that's the next part here, transparent, immutable via the blockchain, which I'll make a note on that front. I do think that something is going to have to be done on that end before this can actually be widely accepted as a legitimate currency. People want their tax money.
Why is that? Not to cut you off, but why is that?
I think, and I'll get into it more in the next slide as well, but I think that for the U.S. government, say, to start honoring Bitcoin and endorsing businesses using Bitcoin and facilitating these things and the businesses themselves too. I think that the U.S. government is going to want this regulated, because if Microsoft is taking all of their transactions in Bitcoin 100 years from now, and the government doesn't know what the hell they're making or what their losses are, what their profits are, anything like that, how do you tax them? That all gets very nuanced and confusing. So I think that while it is something that makes Bitcoin so great, the anonymity actually can be a drawback moving forward as well as in the context of wide-scale integration. But Yeah, and then 2008 financial crisis, major moment for Bitcoin, loss of trust in traditional finance, and these things still happen. You still have runs on the banks. We just saw that Silicon Valley Bank last year, the year before, there was a run on the bank, and suddenly they need bailed out. And we have a 0% reserve requirement still right now, so I don't fault anybody who lacks trust in the banks. And this is an asset that is completely ambiguous of the banks. If there was a total run on the banks and everybody can't get their money out, if you have Bitcoin, you'd be good to go. So yes, and then also introduce the concept of digital scarcity. This is a very, very interesting thing to me and has always been the most interesting facet of Bitcoin. And I believe that the reason it began to run in the first place was because it was getting close to the cap and then has now hit the cap, if I'm not mistaken. But Bitcoin is like gold in that there is a finite amount, and that as and it goes away. People buy these things, will buy Bitcoin and lose access to their wallets. There's the Satoshi wallet still out there with God knows how much Bitcoin in it. And so, it's very interesting. And it is a market. If someone decides, and this is how financial assets move as well, of course, but if someone decides that they want to dump 100,000 Bitcoins back into the supply, that's going to kill the price of Bitcoin momentarily. I don't know if 100,000 is a justified number. Maybe 1 million would be better. But there is a number where you could just kill the price by simply taking down the scarcity, as opposed to a traditional financial market where your selling may hurt the price, but it's not because of the scarcity of those shares. It's because if you put enough selling pressure on, the price must come down. There's not enough bids to keep the price where it is. That while that is how Bitcoin moves, it's not why Bitcoin moves. It moves on giant sales and giant purchases because it is scarcity. And because when somebody buys 1 million coins, when MicroStrategy buys 1 million coins, it tangibly affects the entire market and the supply of Bitcoin. So it's fascinating.
Most definitely. I know, that 2008 financial crisis. It's not too much of a surprise why you might have lost a little bit of trust in the traditional finance, like you kind of just touched on too. And I see over here, not to get a little sidetracked, but I see Kraken purchased NinjaTrader, which I did not know that was the case. That's actually very, that's some news. I did not know that. I know Kraken was a little bit known more on the crypto side, facilitating a lot of those transactions. NinjaTrader, if I'm not mistaken, I don't believe they're their own broker, if I'm not mistaken, but I know they do have a front end software too. But kind of crazy to see a purchase like that, if that is true. I've not looked into that one. Slide 4 here. Is this one that you were going to touch on?
Yeah. All right. Yeah. Lots of things to say here. So will Bitcoin be adopted by the masses? I think the first point is that it pretty much has. As far as it is accepted as a legitimate financial asset. Accepted as a currency is a whole different battle. Tesla, PayPal, some nations are accepting Bitcoin. I believe El Salvador holds their entire Federal Reserve in Bitcoin, if I'm not mistaken, which
that's insane.
They're up.
Insane.
They're up. I'll tell you what, that was a fine move. Odell Beckham Jr. took his Rams salary in Bitcoin. There's a few people like that. And then, countries like Switzerland accept Bitcoin for taxes, which, again, this is where this gets very nuanced to me. I don't understand Switzerland accepting Bitcoin for taxes, because if you're just going on the legitimate Swiss francs that they made in a year, I believe that's their currency, and then all of a sudden they pull out some Bitcoin to pay their taxes with, me as a government, I'm saying, man, how much other Bitcoin do you have? Where's this coming from? Are you making gains on this Bitcoin? I know that you are.
I gotta ask. You're making such a good point, and you almost alluded to this on one of the previous slides. It almost feels like it defeats the purpose of a blockchain and having something decentralized, even if there was regulation. I know this is there's a lot of skepticism right now, or it's just in the air. But even if there was to be regulation, could there not be another network or another blockchain or another coin produced that's outside of the power of government regulation? It's like, wouldn't there just be another? It's almost like we're going to do what we just did to the USD to Bitcoin. It's going to force somebody to create something new for us to have the decentralization again. And it's like we're kind of a dog chasing our own tail now. Same cycle over and over again. That's what it seems like right off of the bat.
Yeah,
but 100%.
I absolutely agree. Yeah. I think dog chasing its own tail is a great analogy, because there's a constant battle, between people who want this to be a currency but simultaneously want anonymity, and I don't know that you can have both things. Use cases expanding into store of value, digital gold, payment rails, all very valid use cases. But yeah, this last bullet point is the most critical bullet point in the entire slide deck to me. Volatility and regulatory uncertainty are still hurdles, and they're still big hurdles. And I have 2 points to make on this. I've made my regulatory point already, I believe. I think that if Bitcoin was to be this widely accepted thing, something you could receive your salary in, transact with on a daily basis, the governments of the world, not just the U.S. government, are going to want to know where this money is coming from, going to, and be able to tax you on it. On the volatility side, this is something that I just wrote a piece on Reddit about this the other day, that I understand even less, is that Bitcoin is insanely volatile. I mean, it's noted for its volatility. So if I'm leaving my house and I want to walk down the street and buy a cup of coffee, and the price of Bitcoin goes down 1% by the time I get there, the price of the coffee has fundamentally changed. If they're pricing it in Bitcoin, my buying power for the coffee has decreased. It's essentially become more expensive to me if they're not doing anything to tweak those prices. And beyond that, when you get into bigger ticket purchases, say you wanted to buy, use some Bitcoin to buy a house. What if you have $20,000 in Bitcoin, it loses 1%, and then you're showing up to sign your closing documents and suddenly the transaction can't go through because Bitcoin isn't worth as much as it was 10 minutes ago when you agreed on the price. So I think that the volatility creates lots and lots of holes to me. I would be very interested to hear anybody in chat who might have input on if I'm missing anything here. But that's what's always jumped out at me, and why I have opportunities now to use some Bitcoin if I ever wanted to. Like deposits and withdrawals on a lot of sites will allow you to use Bitcoin, and I choose not to because I don't want to have to deal with the volatility even in the 20 seconds between when I withdraw in Bitcoin and when I turn that into cash. So the volatility is a huge red flag to me, and something that would need to be resolved if we were going to do this. Otherwise, it's like, I mean, it might as well be gold, and we might as well be bartering, which I suppose it is to an extent. So it's interesting.
I mean, it is a really good point. I know there was an argument made a lot of the time that, Bitcoin is a new standard for, it's like digital gold. And I see a comment here. It says, sometimes you want gold, sometimes you want silver, sometimes you want Bitcoin. I really like the phrase of that statement because it's kind of just saying it's a different flavor. I know we tried so hard to make, this is a digital gold. But so far it's not looking like Bitcoin is proving to be the digital gold right now. It's still looking like gold is proving to be gold. So, in terms of value, the volatility of it, I mean, that's definitely probably the biggest fork in the road. How are we going to sustain something when the volatility of that asset is having volatility, that's not going to make anybody feel comfortable on a day-to-day basis. So we'll see what happens here. I mean, in terms of regulation, this is going to be an interesting one because, again, as you know, the government's going to want a piece of its pie. But I think that this is going to be one that the government is going to have an issue with when it comes down to regulating. I think they're going to be able to regulate some portions, some parts. They're going to be able to tax things the way they want to tax. But when it comes down to knowing somebody's crypto wallet, like I believe the government's going to be able to see and view what's coming in and what's coming out. But I think they're not going to be able to put their finger on who owns this address or who owns this wallet. I think that's where they're going to have the issue. I think they're going to be able to see all these transactions, be able to track all of that. But a part of the purpose of, crypto as a whole was the fact that, you want to have to know whose wallet address it was. But at the same time, it provides a lot of, what's the word I'm looking for? A lot of transparency is the word. So it's like a public ledger. So we'll see how this environment kind of develops and expands from here. I'm excited for it regardless. Again, it's not like we're trading crypto like we're trading a lot of these other assets, but whenever Bitcoin and crypto, whenever the topic is that, it's always an interesting one to take part of. So there's our take on crypto.
Yeah, absolutely. And it is. I mean, and I will say this too, in a vacuum, as I don't have problems with Bitcoin, and as a growth asset, I really like it. I hold some myself. I have no problems with that. I just see hurdles as we move into trying to integrate it as a currency in the real world. Though I will add, to play devil's advocate, everything I just said about Bitcoin is also true to an extent with cash money. But the issue is that it's very difficult to pay in cash money for large transactions that would need taxes, like buying a house. You're not going to, I mean, maybe Floyd Mayweather does, but most people aren't pulling up to the closing with $200,000 in cash on their person, which would make it all harder to track. So yeah, it is. It's interesting. It's very nuanced, and I'm excited to see how crypto develops moving forward.
Yeah. Before we wrap here, I am curious on your stance when it comes down to Bitcoin. I know you hold a little bit of Bitcoin. Is it more on the fence of, I like this technology, or is it more on the fence of, if this comes to fruition, I don't want to miss out, and I'm being a smart investor by spreading my seeds out a little bit so that I can take advantage of any type of upside move, or is it a little bit of both?
I think that both of those are more sophisticated than my line of logic. I hold Bitcoin because Bitcoin go up. That's really the reason. Bitcoin go up. Go to the next slide. Bitcoin,
me too.
Bitcoin go up.
Oh, right. We got one more. Right. Bitcoin yearly performance. So Bitcoin has proven to increase over the years. And as you can see here from 2010, I mean, look at the price of that Bitcoin beneath a penny in 2010. Annual return just shy of 10,000%. We got 2011 sitting at about 30 cents. 30 cents doesn't sound like a lot, but that's a massive increase from just the prior year. So 2012, 425, 2013, 1350, 2014, we got a pretty big jump back to 805. Pretty big pullback in 2015, back down to 320, 430, 960 in 2017. That rise that we talked about, that popularized crypto and Bitcoin as a whole a little bit more. Then 2018, we started to see a continued run, had a little bit of a pullback, went back down to about 3,700, 2020, 7,200, so on and so forth. But as you can see, Bitcoin is on the up. So if you need a reason to get long Bitcoin, I mean, you heard it here first about my man's Gus right here. Bitcoin go up. So we're on the ups.
They do.
That's the perfect way to put it.
Bitcoin do go up. Also worth noting, and this is baseless claim, but since 2011, we go 3 green years, 1 red year. To the present. So if that
3
trend,
green years, 1 red year.
Yeah, if that trend continues to hold, that would mean next year will be a red year for Bitcoin. So we'll see about that. But yeah, and it's just crazy because if you look at any of these year start and year end prices, you would have to be a madman to be buying at the end of that year. If you looked at a chart of something that went from $960 to $13,000, you would be like, no way I'm touching this. This has to come down. This is ridiculous. Right. This is Palantir, whatever. But it just keeps on chugging. I mean, it actually did come down the next year, to be fair, but just keeps on chugging. We just keep having these years of triple digit and large double digit returns. And I mean, it's outpacing the market like crazy. So yeah, it's just, and
look
also,
at these annual returns. Good Lord.
Oh yeah. And if I'm holding since 30 cents, I sell in 2014. There's no way I'm still holding right now. So yeah, it's just
30 cents.
Yeah. Maybe not even
2013. Yeah, not even there, man. I would have been out maybe.
That's true. I'd be out when I 10x'd, if that. I'm out sooner than that. I'm out when I double my money. So it's just, you'd have to.
Yeah, unfortunately, I'm out at a penny I'm out at like $2, honestly. $3.
The people who have it the best are the people who find their wallets that have 300 Bitcoins in them right now because you didn't have the chance to sell this entire time. you were forced to diamond hands.
I remember when I first got into trading, when you first start exposed to trading, your natural inclination is to buy something as it's already going up. It's like if Bitcoin happened to be your first experience with any market and you saw it going up and you just were like, oh, I'm getting in, that natural habits, you probably were blessed on a position like Bitcoin. So I hope everybody finds their wallets. I see some people lost their wallets in the chat. I hope one day you find those wallets so you can retire all your kids and your grandkids because those are probably up a pretty penny right now. So if you find your wallets, Gus and Errol will be on here Tuesdays and Thursdays. We'll drop our emails in the chat if you ever find those wallets. But anything else to add before we hop on out of here today, Gus?
Yeah, no, nothing. Good luck. Good luck on the wallet recovery. I would imagine that's quite a frustrating phenomenon.
Bro, I've seen some stories where some people go digging to find their wallets. Like they will search through everything because it's like a jackpot if they can find it. So
yeah. So happy hunting. I wish you all the best. May you find 100 Bitcoins in your wallet and retire.
Absolutely. Well, that's going to do it for today's segment. A little bit on Bitcoin and the yearly performance. We will be back next Tuesday, breaking down our risk of the week. So we'll give a little bit of an update on our portfolio. We'll be putting on a new risk as well. Shout out to the target position, Gus. I know you added me on Twitter, and I seen the down move on target. So hats off to you. We'll check that out here on Tuesday. But that's going to do it. Thanks for joining us, and we'll catch you guys in the next one. Peace.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
Oh, yeah. Tasty Nation, good morning.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at tastylive.
If you missed the live show, here's our cherry on top yearly recap.
So, we're doing the show on Friday, and the bat, he's doing the show in the morning, then he's going away afterwards, right?
Yeah.
He's all packing up the car, he's doing his stuff.
RV.
Packing up the
Packed up the RV for a 6 to 8 day trip. We're supposed to be there about
4
48
days.
hours.
I bet him $20, and I said, you'll be in a hotel by either the first night or second night.
And then I vociferously stood up for you.
Of course you did. You should have, because that was the smart move.
I appreciate you. You're
yeah.
good.
Saturday morning, I look at my phone, and it says, Venmo, $20.
I almost had to pay him $40 because there was a little stipulation. If I didn't sleep there one night at all, I'd have to double the bet. I almost had to send him $40.
What happened?
See what happened?
Here, what happened was
we're driving up there. It's absolutely beautiful. It's like sunny as can be.
You were tweeting pictures.
Oh, yeah, it was beautiful. It was beautiful.
Instagram, you're like, I'm here in the woods.
Absolutely beautiful. Absolutely beautiful.
Amazing.
It was gorgeous. We were gonna make a slight right-hand turn. We got about 10 miles to go, and up ahead there's this dark cloud, and it's raining. It started getting muddy, and dogs are getting all muddy. Wife's having a little problem. Bugs are everywhere from the rain. And I realized at that moment that my wife was not a camping gal.
That's a surprise.
So at 6 o'clock in the morning, I pulled everything out, closed everything up, shoved everything underneath, and I was home. We actually left because we did the show at 10 o'clock in the morning. So we left at 10:30. I was home at 10 o'clock in the morning the next day. Look at him.
You were just
jumped in my pool, looked back at my house, and I said, why would I ever leave? Why?
He was going to go fishing, catch
He's hurt on this one.
Muskies. Some bass.
Very quiet.
I left Friday at 10:30. I was back Saturday at 10.
AM?
Yeah.
You didn't make it 24 hours?
No.
Who broke down?
They all did. They all did. I rented a boat for Saturday, but the boat was broken. It rained for 5 hours. When we got there, it was...
Now the RV on rvtrader.com.
No. Yeah.
Whoa, wait a minute. How do you get to Florida now?
I don't care anymore.
Oh my God. First of all, I'm sitting in the captain's seat. I've never been invited to come sit in the new captain's seat. But what I'm concerned with is the size of these screens. And then he's still doing this.
No, let's take a look.
They did not hold that rally at all.
Phil, you got a partial.
973.75. I'm looking at this like I have to move my head to get through the top, the top symbols. I thought he had like a little computer and he was getting down.
He hasn't learned that he could swivel his head. He has to see the screen. He has to go like this to me. And then you know what? Money goes to money. You did it. Good job out of you.
Yeah.
I just drove with him twice. Now I'm really concerned that I was just in the car with him for 2.5 hours. Okay. I need help understanding. This is the largest monitor that I've ever seen. Like, I have to move back in order to see everything. And somehow when you're on air, you're like looking at this, you need some help.
Nope, I got everything fine. The problem is I just have a lot to do. You see, because in your job,
here we go.
Really all you have to do.
Get the full scoop by checking out the archives at tastylive.com.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Oh, yeah, it's Thursday, May 22nd, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast. Let's try that again. A little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world, and they're giving us our money's worth. More on that in just a bit. Before we get there, let's say what's up to the people. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't already have both, go get them. But if you want to be part of Bing, this chat box on your screen, there's only one place you can do it. That's on the evil Google YouTube. I don't put I noticed earlier in the week I said perhaps cheap or inexpensive Google, but not so much more. We had a little breakout to 175. So the evil Google YouTube is not as expensive. One of these days they're going to break that company up. Either they're going to be forced to do so, or they're going to roll YouTube out into its own instrument. The only question is when. And if they did have two. If they did have a Google, let's say it had Google Y and Google L, and Google L was the search function in AI, Google Y was YouTube. Which one do you want? You can only pick one. Tell me in the chat. But, okay, so that's the whole part. So do me a favor. The more active you are in the chat, the more we spoof that Google algorithm into putting us in front of as many people as possible. So introduce yourself to the fine people here in this chat. I'd argue they're the finest people on any corner of the internet. Do me a favor, move those phalanges, those metacarpals, or even bash your face into the keyboard if you're dedicated enough to create random ass characters. We would all appreciate it. You'll help us save the world, deprogram the world, one view at a time. That said, we should shout out to everybody that's actually in the chat. Oh my goodness, I don't even have it up. Give me a sec. Talk amongst yourselves. Oh, Victor Jones. Me and Mr. Shout out to Catan, Grumpy Mike, Mark, Brian Watson, the YouTube GOAT, D-Chat, Lone Sophos. Everyone picking YouTube. Interesting. I think, you know what I'd rather have? I don't know if no, that's not true. Let me come back to that. Absolute Beginner, what's up? Edward, Howie G, how are you? G, do not know what Victor is smoking, but I wish I had. Howie G's always in the comments throwing a little shade. I don't get it. I'll tell you what I'm smoking. I am smoking. It's more. First of all, it would be harder, I think, to enjoy a 90-minute stream of a guy who was super dry, didn't have the stones to throw a few dad jokes in here every now and again. That's what I'm smoking, and just generally an appreciation of life. Trev J, John, Chaz, A, Grumpy, did I say your name already? If I didn't, go buy a lottery ticket. It's your lucky day. But all of you, I could wish I could reach through the screen and give you all a big consensual hug. You're not going to get me. Giggity. Yeah, you know what? I wouldn't mind owning YouTube. I definitely wouldn't mind owning it. I guess the question would be, the thing I slipped in there on you is AI was in the other one. AI was in Google, and YouTube is the content company you know today. So where would the explosive growth be? Where would the explosive growth opportunities in YouTube be? Might be a really interesting asset. Probably pays a dividend, something like this. But I don't know. I guess let me ask you this question. Let's see what type of audience we have. Would you rather right now, if let's say YouTube was traded on its own independently, would you rather own YouTube or would you rather own, what's the other one? Rumble. Rumble is publicly traded. Would you rather own Google or YouTube or Rumble? That's going to break some of your brains. AI overbuild. Gotta go YouTube. I like that. Son is a gangster of a contrarian if there ever was one. I really appreciate a lot of your guys' opinion, and Son is in that category. Coog or Rumble? You know what I don't get? Let's start here. I sort of understand the need. I want to call it the need. I sort of understand why there is a Truth Social, right? Because at one point in time, former President Trump was kicked out of all social media. So he has no ability to get out his message on social platforms. So he's like, okay, if I can't do it, I go over here. I'm going to start my own. There was also sort of a concerted campaign to silence certain ideas or certain groups of people. And those people said, I'm going to go over there. So I kind of understand why there's this little offshoot. I don't like it. I don't think we should all be in our little echo chambers. I'd much rather us be on some public utility where we all have some shared rules of the road and we can see each other's opinions and engage should we choose. But at least we can see each other's opinions. But I get why there's a True Social. The Blue Sky thing, I don't even get why it exists. Because it's not like anyone was censored. It's not like Joe Biden or any Democrat president was thrown off of social media or couldn't get their message out. So that exists only because that group of people doesn't want to hear other people's ideas. And I don't know that that's a great reason to exist. Sort of strange to me. I was thinking about that the other day. No shade to people on Blue Sky, no shade to anybody with certain opinions. I'm just saying, like, I understand that they say necessity is the mother of invention. I understand the necessity in one aspect. I don't get it on the other. Let's see what you guys are saying. I'm gonna start some fights here today. I'm just kidding. I went on YouTube because Rumble users spend their money on golden bullets. Oh God. But Rumble is the bigger growth. Yeah, that's the thing. It's a good joke, but there's an interesting growth opportunity there. Perhaps. This is the thing. I don't know what the differentiation is other than sort of this perceived freedom to be able to say more things. And that can easily be, I think that can, if Google took a different stance for whatever reason, they could easily remove the differentiation of Rumble. That's the problem. You want a task, raise good kids, it comes from a solid core. Amen to that. I watch more content on YouTube than cable, agreed. I think it's more about people not liking Elon. Yeah, okay. No, look, I get it. I'm not saying, again, I'm not throwing any shade. I'm not throwing any shade. I just, not liking somebody or not liking opinions that are being shared is much different than being silenced. Elon would I think he means censoring. If he's censuring people, Just saying I don't like what you said is one thing, but censoring them is different. All right, let's move on. Now that I've kicked a hornet's nest. A great way to start the show, Victor, alienating 50% of the people. All right, let's go. The S&P 500, my babies. Wild day, absolutely wild day. But that's every morning for the last 2 weeks. I swear this is how it's felt. Every morning, almost without fail, over the last 2 weeks. I should have counted them because I knew I wanted to open the show going this route. But we've been down maybe 0.5%. There was the one time when we were down about 2%, and you end positive. And I can't help but think it's this very interesting sort of dynamic, I think, where the market is down 2%, and anyone that's quasi-bearish or at least nervous, neutral to the marketplace, they don't fire because they're like, this is the day one of the rollover. And they just eat it up. Whatever discount is available for some of these instruments, they keep eating it up. And so you've got like a group of market participants that are looking at these discounts and they're either hoping for a roll or they're nervous about a rollover. And then there's a group of participants that are rapidly eating up all of these discounts. And, because even myself, it was hard to stand in the pocket this morning. It was hard to stand in the pocket because everything that I had on. So I kind of have this barbell, right? If stocks work, then I own stocks over here. If they don't work, I have an assumption about what will work in that world. And my hope is that those things are going to work as a potential offset. Or if not, I'll make even more money on the things that I think will work because I'm a bit more leveraged on those things. Those are usually like futures options, those types of things. And this morning, man, they had stocks down. They had silver puking. They had bonds at their lows with a gun to their head saying, I'll do it. Bitcoin was really not necessarily performing. And it ended up coming off just a little bit. So all the areas that I'm using as sort of a quasi hedge, it wasn't performing. And then you got stocks not working either. And it was like, I'm like, all right, what do I do? And the choice was actually add to some of those. I added a little bit to silver. I added a little bit to bonds. And then sort of I didn't want to over-rotate on stocks to the downside. And in end of the day, where are we at? We're at the S&P 500 cash closing 4 basis points lower. We're at the NASDAQ up 15 basis points. And you cannot deny that there is clearly a preference. There's clearly been a preference over these last 2 weeks for Mag 7 stocks. I mean, it's an obvious pattern that the NASDAQ is outperforming at least the Russell on a daily basis. The Dow Jones ended up exactly flat, and the Russell down 5 basis points. And you think about just this world on the screen where you have higher and higher interest rates. And that's tough for many small businesses. That's going to be tough. And you can sort of make the case, rightly or wrongly, you can make the case why that's going to be a tough environment for the smaller, more leveraged businesses who have to roll over debt at ever increasing rates, right? It's just he who has the most cash, the most capital in a world of higher borrowing costs is going to be less affected. Is going to have the ability to command a discount on their cost of capital relative to other players in the game. And that's just getting priced in here. And it's the same way that if you see a relief in the long end, you stop seeing this little steepener that's been playing itself out over the last couple of days, then perhaps you've got a little opening for Russell performance over the NASDAQ. But right now, the exact opposite thing is happening, and you sort of understand why. The big, dominant cash players in a world of just higher and higher interest rates, they're going to be in a more dominant position to eat up the smaller companies. They're going to have a harder and harder time paying these higher borrowing costs. And they're going to get the opportunity to buy smaller companies for parts, strengthen their businesses. And it's sort of, here's the way I would explain it. I sort of see, and we've talked about this for like a year, maybe more. In the real economy, we've talked about the different experiences for this K-shaped economy. You got tons of money and wealth and cash generating assets, effectively positive carry. Inflation's kind of doing you a solid by inflating the price of your assets. If you're on the bottom side of that K economy, then what your real wages can buy in the economy got squeezed for a long period of time. And I think a little bit we're starting to see that play itself out between the NASDAQ and the Russell. Think of the NASDAQ and the Russell as the two sides of that K in a certain way. And we're seeing that spread widen out. At some point, I think it'll be an interesting bet. I'd rather bet on bonds first, get a turnaround in bonds, and then perhaps look for the Russell NASDAQ spread to revert. But I think it's probably too early on the Russell NASDAQ for me. It's the same trade, but I'd rather bet on bonds just because that's what I'm comfortable. And I'm super small in the trade because I'm nervous. I'm really nervous that I'm going to be wrong or I'm already wrong. And there's probably some of you in the chat that are like, bro, you're already wrong. And I'm mad at you for saying it. And I had that discussion with Tom this morning. I know I'm starting off with bonds here, but I had that discussion with Tom this morning. 107, just for the ones at home, the lowest we've been in the last couple of years is 107 in the bonds. And that was back on April 23rd of 2023. Let's take us back. The way back machine. Let's go weeklies. Here you go. April 23rd of 2023. Now, bonds, ZBs, contracts looks like they just rolled over to the September contract. So you're not going to see where we were at. What were we? That's fine. But the point is the low was 107.04. And after that, our low was April 7th, if you can remember. That's when rates spiked to 5%. We're already below that significantly. That low was 111 and 17 ticks, and we got below that. We are now sitting at 111 and 6 ticks. So for as much as the world felt dangerous at that time on April 7th, that was more the speed. But in terms of the actual yield itself, you're there again. Rezo says, yeah, but I thought buying 108 would be a good place to begin buying. So, yeah, you just, again, we're playing cards here. I do think we've seen this pattern with bond yields. It's like we reach this level where everyone gets really nervous about, then bond yields back up. Everyone gets comfortable. We go and get to that place in bond yields again. Your markets are not as nervous. They've also, on the first advance of the yield, they destroy anyone that's over leveraged. This happened sort of like in the it happened, when was this? Try to. So in January, I would argue back in what was it? It was August. It was an August move, but in January it's happened. We get the same thing in April. If I went back far enough, we had a couple of these prior. It's like we make these gigantic advances in yield. We blow somebody up. We back off of it. Then we make another advance and we go a little bit further before coming back. Make another advance quickly, blow some people up, move ourselves back. It's like we're taking out leveraged players one by one, moving back, and only those that sort of that aren't over leveraged or haven't taken ridiculous positions sort of continue to play the game. And I know what I'm saying right now is probably a bit of like hindsight bias. I'm just saying that we keep seeing this story of some fund blows up or some trade blows up and then we back off. Some fund blows up, some basis trade blows up, and then we back off. And yields are able to advance in a way that's not going to create systemic risk because you only get a few players at a time that are blowing up. I don't know if that's true or not, but it seems to have been at some level. We've had these 3 moments in time where yields have done this. So I wouldn't say that like 5% because we got to 5% a month and a half ago, because everyone was scared about that, because Donald Trump changed his rhetoric on tariffs and backed off of 5%. I don't know that I look at the market and I go 5%, some line in the sand we can't go above. Because you would have said that about 4.5, 4.25, and 4 if we go back a year, maybe 2. So I think I wouldn't think about it that way. I think in time we'll find higher yields. Right now, I like the odds of betting the counter trend move. And I do think it is a counter trend move. I do think ultimately we see higher yields. And sort of, so I can hold 2 thoughts in my head at the same time. I can think to myself, this move seems a bit extended. I want to play the counter trend bounce. Some people don't like to trade the counter trend. I do, and I can also think that over time yields can make their way higher. And that's how I kind of think about this story. I think the move in the actual curve itself, it's steepening out just a little bit. Not much. Still at 54 basis points. But the whole thing's just floating up a little bit higher. Go back to our rate probabilities here. They're tinkering around with the probabilities in September. The other day we looked at this, I believe it was like 93% probability of a cut starting in September. It's backed off a little bit to 80%. And then a hold, a near 100%, 98% probability of an additional cut into December. I got to be honest, man. The more I think about this, the more I think about it, I don't think there's a snowball's chance that they can cut in September and the long end yields don't go up again. Unless we price it all in now. So unless yields go crazy to the upside and then everyone's saying the Fed can't cut, but the Fed keeps it live because they've already priced it in, and then you get a cut with corresponding drop in long end yields. I think that's possible, but I think given where rates are priced now, if you told me the long end is where it is right now and we're headed into September, I'd say there's no way they cut without raising the long end. And then you have to ask yourself, what's the goal? What is their goal? Oh, excuse me. I'll take a quick look at VIX term structure. They have settled them out. Even since yesterday, VIX 2028, a little lower in cash. VIX future is still elevated at 2055. Looks like that 17 vol was a little gift from the gods to people that buy premium anyway, to people that were looking for a little downside insurance. My goodness, Victor. There you go. Not the cleanest little VIX term structure I've ever seen. A little bit of a camel hump here. But still normal to an extent, mostly in contango, except for, what is that, probably November and December months. but elevated volatility here at 20. This is probably a really great market for you premium sellers. Right now, anyway. There's sort of, I would argue, there's less, I think, tweet risk in the market. There's going to be tweets, but I think there's less risk of a tweet creating an outlier risk right now. The risk would be, some aggressive language towards China, that negotiation behind the scenes. I think one of the positives for the market is it seems like those negotiations are not being played out through the public. For all of the crazy things that Peter Navarro has said, the one thing he said the last time he was on CNBC, I believe it was the last time, he said something to the extent of, if it were me, I'd have the negotiations with the Chinese in private. He said something to that extent. And I thought that's a very interesting point that it's coming from him. And I think to a large extent, it seemed like those discussions are not playing out through the media as they did back in 2017. I think that's probably a good thing. And that lowers your sort of outlier risk, I think, on one sort of proclamation or announcement from the government. And then you have elevated volatility right now, 21. Bond volatility is high. A lot of vols really elevated right now. And I could argue that you have seen very sideways choppy market. You start down 0.5% or start down 2%. You end the day positive. But I think it's an interesting environment for vol sellers. I can't pull the trigger here at 58.50 on selling vol. I wouldn't mind selling some puts if they can bring them back down to 5,600, but that might be wishful thinking. We'll see. Let me pause for a second. I'm sorry, I'm not even seeing what you guys are saying here. Jeremy Wallace says they will not cut rates. Jeremy, were you the one that said, mark my words or take a screenshot, they will not cut rates this year? At 4 cuts. Somebody in the chat said that. I did take a screenshot. I gotta go look for it. Big Beautiful Bill is up next. Black Swan or throw cash at us. Somebody asked me a really good question on Twitter in my DMs. I'll answer them directly as well. But I didn't have enough time to answer it. I saw it just before the show. I think the general gist of the question was, what do you think about rates? Do you think rates going higher, they go higher until they bring stocks down? So I think what's happening is people have this tendency to sort of just replay out previous price action. And then they just play that price action. They go, because in 2022 rates went higher, therefore rates going higher now will bring stocks down. And I don't think that way. I think there's way more nuance, and I'm going to explain the nuance. In 2021 to 2022, when the Fed raised their short end, a couple of things happened. The long end did lift with it, but it didn't go all the way up to 5 1/4. That we had this disgusting inversion of the yield curve, because while the long end rates did rise, they stuck at a certain point, and they said, "You guys, this is a game. You're going to lower those rates." So long end yields kind of got stubborn. They didn't go up to certainly where they are now. So the market at that time, it did respond to lower rates, to higher rates, but it also was sort of responding and forecasting a problem with these higher rates. That because you went up so far, so fast, that you're going to have an issue. That issue is going to cause you to bring down these rates fairly quickly. And ultimately what happened, and I said this to Chris Vecchio, is like the government the administration, President Biden's administration, ended up juicing economic activity with a lot of their spending. I think $7 trillion added to the national debt, something of this nature. And I don't think people necessarily expected that level of sort of like this fiscal impulse. So what ends up happening is, in the short run, before the spending, stocks go down, they're adjusting to the cost of capital. But they're adjusting the cost of capital ceteris paribus, expecting all things equal. But once the additional bazooka money gets introduced into the economy, people realize like, oh, the money's got to go somewhere. So even though rates are higher, the question you ask yourself is, where does that money go? And ultimately that question was, in some way, shape, or form, it goes to financial assets. And I think, yes, rates are going higher. But why are they going higher? They're going higher because of an anticipation of additional borrowing. And it's not great for people that are investing in bonds, right? You're buying a bond, you're getting paid back in the future, the currency's future buying power. So it's not good for you. But if you are passing on your first year a budget that adds, some say, $4 trillion to the deficit, the flip side that people got to remember, you got to ask yourself, that's a lot of money. And you got to ask yourself, where's that money going to go? So I don't think it's like this. I don't think this is a really easy question, which is rates go higher, stocks must come down. I don't know that I think like that. Right? I think it's a bit more nuanced. I think there is an area that if we go too far in yields too fast, it will create problems for equities. It will create problems for the multiple. But I think I was having a conversation this morning. This is a really weird cycle. And we are in this place where it's really, really hard for a fiscal authority to come in and say, we're going to balance the budget. Because we're on this run rate where every president adds, on average, I think since Bush was like $500 billion. I want to say, hold on, I have it. I did this. I got really curious. Sorry for the pause here, but let me read it to you. There we go. So on average, Bush added about $500 billion annually to the deficit, or to the national debt. Obama added about $1.2 trillion on average throughout his 8 years. Trump added $1.9 trillion throughout his 4 years. Biden added about $2 trillion, a little over $2 trillion. So the economy is like, it's functioning, it's breathing in, it needs that money. And just coming in and saying, I'm going to pull that, we're going to balance the budget, that's $2 trillion that doesn't go to capital. It doesn't go to the marketplace. It doesn't go into the real economy. And now you've got a problem. But right now, every person that comes into that office goes, well, it's not going to be me. I'm not going to cause that level of pain, because you would have a lot of pain. The market, the economy, people are used to getting that money in one way, shape, or form or fashion. That money's going out through the economy and going out. It's going somewhere. Either it's being spent buying goods and services, or it's buying assets. And you come in and say, well, okay, I'm not going to spend. I'm not going to be the guy who adds $2 trillion a year to the national debt. I'm going to add one, then I'm going to balance the budget by the end of my 4 years. Well, that's like, that's anywhere from $2 to $8 trillion that you're not going to send out to the economy over 4 years. That's going to be, you got to figure out, okay, where's that money not going? And then price it accordingly. In this case, this guy's giving you a signal that they're going to blow up, they're going to completely blow up the national debt. So yes, yields go higher. But stocks only go lower if they want to price a lower multiple on the earnings, which they don't necessarily have to. The more funny money we create, like over time, that average multiple, it has a trend to it. That average multiple over time actually has been trending higher. So yeah, I think there's a level where if we get to it too fast, I think it causes some pain and consternation. But I think I want to ask myself, if it's going up because we have these gigantic deficits and we're unwilling to address them, well, then the market's actually, it's saying not just because we're passing this budget today, it's saying that over time, it's going to be harder and harder to address this problem. The pain of trying to pull this back and get to at least 3% of deficits to GDP is going to be harder and harder to do this the longer and longer we wait. And if it's harder and harder to do it, it's going to take more and more intestinal fortitude of a politician to make it happen. And it's less likely that any politician is going to have that intestinal fortitude, which means you always do what you've always done, and you got to start pricing that into long end yields. But that money that these people are going to be putting into the economy, it's going to go somewhere. So I don't think it's as straightforward as yields go up, stocks go down. It could be, but at the moment, I'm thinking of it with a bit more nuance. Let me pause for a second. I keep saying that, but not engaging in good faith. All right. And that's why, at some level, only one thing to talk about today. Exactly. That's why, at some level, the whole Bitcoin thing, it's picking up speed, because I think you got institutions that are going, geez, they're finally waking up. The zeitgeist of the whole public is wild. I was talking with Michael Guyad this morning, name drop, but I was talking with him this morning, and I go, it's been crazy how the Overton window on the debt discussion has finally shifted. The Overton window just a few years ago had almost convinced some portion of the world that MMT was a real thing. That printing money didn't have consequences, and that borrowing money doesn't have consequences. And now we've gone from that to, okay, MMT might have been a little crazy. Rates do matter, but debt right now, it doesn't matter. It may at some point in the future, but everybody's been worried about it since this. I heard this in the 70s and in the 80s and in the 90s and in the 2000s and the aughts. It's a broken clock argument. It's never right. And every once in a while, people get scared on yields, and then you realize there was no reason to be scared of yields or debt. But I think that's only true within the debt cycle. So a debt cycle is like what, 70, 80 years plus or minus? So if you've only traded inside of that debt cycle for, let's say, 20 years of the tail end of a debt cycle, or 40 years through the middle and to the end, if you don't study history in the cycle of debt and how that blows up over 80 years, or how it impacts society over 80 years, well, then you could talk yourself into seeing that your observed reality is this: debt doesn't matter. But if you don't study the history of money or the history of debt cycles, you're going to have just your observed reality. If you study history, you get a completely different context that, yes, it does matter. And what happens is, inside of the debt cycle, that's enough for 4 generations. And the first generation understands that debt matters. The second generation, less so. The third generation is convincing themselves it doesn't. By the fourth generation, they don't think debt matters at all. And because you don't think debt matters at all, you run up the tab and it blows up. And so I sort of think the Overton window has moved so fast from debt doesn't matter at all to, oh my God, what have we done? We need to do something about this. And some people will say, I know I've concentrated on bonds and debt mostly today, but I think it's relevant because we're at 5% in yields and everybody's talking about bonds and interest rates. But some people will have argued with me and they'll say, Victor, you can't talk about the absolute level of the debt, 36 trillion. And I go, okay, fair. What about debt as a percentage of GDP? We're at like 7% right now. And by some measures, we'll be at 10% if we don't stop what we're doing. What about that? What about total debt to GDP at 130%, something like this, and climbing? There's almost no metric, there's almost no metric that you can look at and point to and say, see, it's fine. It's blown out by all measures. And, you could listen to people like Ray Dalio, like Luke Groman, like Paul Tudor Jones. I mean, all these guys. What's his name? Stanley Druckenmiller. The only people saying debt doesn't matter are the people who trade stocks. Bond people are telling you it does. And the bond market is the biggest bully in the room. The bond market might sit and let you do your thing for a while, but when it has an opinion, you got to listen. And so all the people that were squawking for so long that it does not matter, deficits do not matter, all this stuff doesn't matter. And it's like, it 100% matters. It 100% matters. Can you walk around taking out loans from all your banks going, debt doesn't matter? I'm like, what the hell? This guy's out of his mind. No, I'm not giving you money. And you think because the whole we're the most eligible borrower argument falls apart too because of demand. When you need to borrow at market rates and your own central bank is not going to buy the debt, you have to offer the market a reason to believe that they're going to be paid back in a currency that matters. In a currency that has the purchasing power that matters. And I think we're doing a worse and worse job of convincing people that that's true. And because of that, I think you got a lot of people that are finally waking up to this is a bigger problem than I gave credit for. And I got to protect my purchasing power. And why is the U.S. Treasury why is the U.S. Treasury Secretary, Scott Bessent, talking about stores of value? What the hell? Why is he bringing up gold and Bitcoin as alternative stores of value? Does anyone else find that weird? Isn't he just supposed to be pitching our bonds? So I think people are sort of waking up to that, and you're getting this, this Bitcoin move at 111. And it's a sort of quiet institutional participation this time. It's not this rabid retail participation. It is an institutional participation in this underlying asset as they search for ways to protect purchasing power into what looks like another deficit exploding presidency. And so what do you get? You get Bitcoin at 111 and you get IBIT at 63. Which is great, man. We talked. What was this? A couple of weeks ago, we talked about buying those deep out of the money calls. I think Ryan Grace. Somebody brought up the fact that when we were talking about buying some deep out of the money calls, that Ryan Grace was just talking about the same thing, and he was buying something out with 200 days to expiration. And so we just loaded. I loaded up on some of those, the 60s, the 65s, and the 70s. And we're there already. We're at 63 already, which is insane. Mark Aguilar says, yep, still have IBIT. AA says your wish for them to push Bitcoin to all-time high triggers risk on regardless of bond market troubles. Yeah, man. No. It's not regardless of bond market. It's the same thing. It's the same thing. It is the people that call this simply. It may be sort of this just like this pure risk sentiment. But I look at it as this sort of chameleon. I think the narrative is the thing that shifts and changes all the time. But the underlying dynamics of what's happening with a scarce asset relative to money that is not scarce, to me, it's like, this is pretty simple. As long as people believe that this has some value and it is scarce, you're going to have a hard time underperforming other assets that are not scarce. And I just think if you just saw a few years ago that, oh man, you could look back as soon as they jacked rates, you go, okay, so basically we're in this position where we either have to put ointment all over our boo-boos and we're gonna have to light this thing up. And every rescue package, you need to understand, every budget gets bigger, and there's a reason for that. All deficits get bigger, there's a reason for that. Every rescue package gets bigger, there's a reason for that. And the incentive for anybody to try to stand in front of that, there's almost no incentive structure big enough to get somebody to stand in front of that. Nobody wants to be that guy. Nobody. Jerome Powell clearly doesn't want to be that guy. Donald Trump does not want to be that guy. Joe Biden didn't want to be that guy. The next president is not going to want to be that guy. So if nobody wants to stand in front of that exponentially growing problem, then you better reach for a life raft. And that life raft is not necessarily U.S. Treasury bonds as it has been in the past. And I think people are waking up to that. You get a repricing of gold because people realize I need underlying collateral that's going to hold its purchasing power. You get an interesting sort of all-time high in Bitcoin for the same reason, but with people that want higher beta, higher leverage to that. Does this all end? You know, if you told me right now that the House reintroduces this bill and it's $2 trillion instead of $4 trillion. I know the White House itself is saying they're going to save $160 billion. You know, I'm not the CBO, but I don't think that's true, man. They said the same damn thing about the tax cuts back in 2016. They said they pay for themselves, and I believe the White House, the White House Council of Economic Advisors, I think they forecasted growth at like 5%. So what happens in order to pass these tax cuts is you got to convince everybody that this concept that we'll grow our way out of this, it's going to pay for itself. How about we pay for it, and then if we get the growth that we need, then it's a bonus on top. Wishful thinking, Victor. Yeah, man, I like Bitcoin here. And it's funny though, there's that meme that when you get high prices, everyone stands in line for the asset. They can't wait to get it. And when you have low prices, there's nobody in line. You know that meme? Bitcoin is just like that, you know? When Bitcoin is 20,000, nobody would touch it. Everybody could tell you why it's going to zero. And when it was 100,000, everyone could tell you why it should be trading at 60. Now that it's 111, everyone's going to tell you why it's completely overpriced. It's gone parabolic. It should go lower. And it's like, when are people going to realize why this asset is doing what it's doing? Don't jump on the bandwagon when interest rates hit 7%, says D-Chat. Donna says Victor's feeling feisty and wants to start a fight amongst the chatters. No, not necessarily. I just wanted to start. It was more a question. It was more like a thought experiment. A smaller company with higher growth prospects versus a larger, more established company with less growth prospects but more safety. So that was the thought experiment with a political overlay sprinkled in there. Retail is beginning to consolidate into Mag 7 and indices. You know, it's so funny, Chaz, that a couple of weeks ago, when you talk to people and the Mag 7s were getting destroyed, everyone had the same narrative that trade that had been going, people just, you don't recognize that, like, these people don't know. You know what I mean? When these people come on and they're wearing their fancy ties and their suits and they have a pair of glasses and they work at some fancy bank, that doesn't mean they know. You know what I mean? I've been doing this long enough and talk to some of these people, and they're really smart people, you know, but they don't know. You know what I mean? And so when they come on after the indices have deleveraged out of the Mag 7 trade, what they're doing is they're going to tell you a story that is steeped in recency bias. So the move has already happened, okay? People have already left the Mag 7, so their story to you is how the future investors are going to be looking for other assets, and they're going to be looking to diversify out of the Mag 7. They're going to be looking to diversify out of U.S. financial assets because that's what just happened. And they tell the story of what did happen as if it's a future story. And they don't know. They don't even know that what they're saying is just steeped in recency bias. They're smart people that don't understand their own cognitive bias and the probability distribution of the next month. No idea. And then they disappear for like a month. You never hear from them again. They come on after the market has already moved to the upside. Everything they said was completely wrong. And then they give a completely new point of view and pretend like they didn't say the thing that they said 3 months ago. Lone says, I like ZB at these levels, love him at 110, but I like him on Monday as well because I stink. I'm in the same camp right now. I want to say I don't love them. There's no part of me that wants to own U.S. Treasury bonds. Let me say that. The narrative I want to tell you, and I just did, is how it's a bad bet. But there are sometimes, I suppose Tom Sosnoff, Tony, and everybody here at Tasty's rubbed off on me. Sometimes I personally got to tuck my narrative nice and neat, stick it in a drawer somewhere, and just play cards. And I think trading against the previous low of 107 at 110, I got 3 points of risk to the downside. And who knows, maybe that 117 is still a magnet to the upside. And if it is, then I've got 2 points of upside to every 1 point of downside. And I like that risk reward. That's all. I'll do a couple more here. Mark says, I'm staying short futures on small caps. Well, if you've had that on, congratulations, my friend. What's up, Saturday night? Victor, did Vecchio hijack your charts? I don't get it. What does that mean? What is wrong with this chart, by the way? Oh, they must have just did I was right. They just did the roll. Why? Because all those lines? No, I do. At one point in time, I was drawing lines on charts. I do it in one only, and that's in the Z. No, I do trend lines in the ZB continuous contract, and then in ES the ES contract, I just do levels. Not complicated levels at all. Sun says they can't cut unless the market goes down 30 to 40%. Their goal is to stop gold from exploding. I don't know. Maybe they don't want it to explode higher, but they're clearly repricing it higher. Job creating tax cuts should be in direct exchange for the actual American jobs created, says Mark. Yeah. The American people always have to take theirs on the come. I agree with that. The degenerate trader says he should rename the show to Victor's Bunker Hour. I don't think anything I'm saying is bunker stuff. I just don't. Here's the thing. I just don't parrot whatever's on CNBC. Sorry, let me not mention a specific network. I like those guys at CNBC. They've always been great to me. Whatever's on main financial news, I just know where it comes from. It's like it's some intern that's writing an article and trying to move up in and as a producer, or some person that loves finance, or they want to be an author, and so they're writing at one of these outlets as a method to get in the door, but they don't trade themselves and push the button, and so you get all these articles. And you're thinking because it's coming from this place that it must be relevant. And it's not. A lot of it is just not relevant. So I can read a bunch of this stuff and I can go, this is all a distraction. The only thing that matters are rates, or the only thing that matters right now is the deficit, or the only thing that matters right now is this high wire negotiation act between these nations. And all of this stuff that pretends to know what's going on in the world. It's wrong. I mean, it's not wrong. It's just, it doesn't allow for the idea that they are wrong. So everybody reads the news and they get this false sense of confidence that they understand the world around them. Nobody even asked the question, what news have I not read? It's like because you're caught up on the news, you think you have a good hold on the world around you, and you don't. And I don't think it's a bunker concept to sort of wrap your head around the idea that there's so much more that you don't know than you do know. And even the models we use, the Black-Scholes model, you read Nassim Taleb's The Black Swan, you realize how many inherent problems there are with that model itself, or with CPI as a model to try to understand inflation, or as unemployment as a model to try to understand unemployment. All of this stuff is an attempt to understand the world around you. It's susceptible to incentives and manipulation. You can look at me like this crazy person, or you can look at me like this person who's been doing it for 18 years. And the person who started out reading the news articles and then trading and thinking that was trading. Or looking at a chart and thinking the chart was the market and not the distribution curve. The distribution curve is the market, not the chart. So you can call me like a bunker boy if you want. But I would, sometimes I wonder which perspective is more helpful. The one that acknowledges a lack of understanding in the world, or the one that pretends to have some full knowledge. for its own benefit. All right, I'll do a couple more. It's sell side bubbly BS. Yes. Barrage? Sorry if I mispronounced that. I know you're in here all the time. And I'm hesitant to say some of the comments I've seen from you only because I don't want to mispronounce your name. So if you give me a phonetic in here, I can be more confident to parrot some of the stuff that you're saying. All right. Currencies, dollar a little stronger, well, inty winty bit, which I think is good for the good guys, which is me, which is my view of the world. If this thing goes higher, I mean, if dollars get weaker here, I just don't. We don't want that world, bro. We do not want that world. People do not want that world. Bitcoin. Oh, we already did that one. Gold. Here we go. Gold at 33. This little gold move was enough to lift the miners a little bit, but gold looks sick still. So do the miners. These look sick. If you didn't get a chance to collar them, I'd collar them now. If you're in some of this stuff and you still want it, and you didn't collar the miners, they basically gave you a redo. Now, to be very clear, you could get an explosion off of this. You could get a little bull flag here, and it explodes past 64 up until new highs on the miners, and a lot of these charts are going to have the same pattern. You could totally have that. But I think it's just how much have you made? If you've made a lot in the miners, as I have, if you were in there with the same around the same time as I have, and you've held them, you're probably sitting on a pretty decent amount. And so the choice for some, if you're a trader, is do I let this thing go and I'll go put the money to work somewhere else? I could totally understand that. For me, it's I still think these things are underowned. I still think they're underowned, and so I'd rather collar off the risk and let them work. So that's what I'm doing, and I'm just calling out that if anyone just didn't do it the first time, you got a little opportunity here. Because gold, the chart still looks sick to me. Silver rejected its 34 sort of previous resistance area. And I asked this question to Chris. I asked this question to Chris yesterday. We were right at 34, and I said, what do you think happens? Do you think we reject 34? Do you think we find our way to the upside? Now, I'm not asking a day-over-day question here. He ultimately thinks silver finds a way higher. I do too. But the idea that silver could reject 35 because we've been in such a tight 34 because we've been such a tight range 32 to 34. I didn't put that out of the cards. So a rejection of 34 to me was not the craziest thing. And because I was sort of prepared for the idea, I bought a little bit more. I'm telling you, this trade's going to take me down. Silver's either going to make me, I'm going to be on an island somewhere, or I'm going to be borrowing rent money next week. I don't know which one is true. I don't know why I'm choosing to die on this hill. But I just think there's a really good setup here. I could be wrong. I still think there's a good setup for silver. We shall see. Ooh, Victoria. This is really good. I'm getting to a situation where I think I'm in an echo chamber of contrarian traders and start questioning my contrary. Now you got it, Victoria. That's the whole game. The questioning of things, then the questioning of things, then the questioning of things. When you do that, now you know why I bought silver and gold and iodine tablets and dried soup and water. When you get to that like level of rabbit holeness where you're questioning even your own questioning, you got it. Let me ask you guys. Let me do a pulse check. What do you guys think of the big beautiful bill? You guys like apart from what it may do to stocks or bonds, if you can separate yourself from that, you guys in favor of the bill or not? Are you guys in favor of its passing? And let's do it like this. In order for this to be a space where I can ask questions like that, let's not attack anybody for their opinion. Engage each other if you will, but let's not attack people. I'm curious, genuinely. Are you in favor of its passage? The reason I ask this question is I almost can't trust. It's not that I almost can't. I don't trust when something comes out and I get a bunch of stuff in my face that says how bad something is, how much people don't like it, what the polls say. It's really hard for me to like take any of that seriously anymore. So I'd rather ask real people. And I tend to find the more I do that, the more I ask real people what they feel about things, the closer to reality I am. When I do all the stuff in the feed and on the news and in the polls, that stuff to me is just, it hurts the way that I think about the world more than it helps it. Bobby Lewis says, nah. All right, let's see. Uptick, downtick says, who would not be in favor of transferring wealth upwards? Edward Landy says, no. Trev J says, more interested in what would happen if the tax cuts from 17 didn't continue. What I think is interesting, Trev, is they've kind of been successful at pitching two opposing narratives. So one narrative is, oh my God, we can't let these tax cuts expire. It would be disastrous. All of your taxes would go up. But then they're also sort of successful at pitching to that same group why tariffs are sort of a necessary and positive and healthy function. And when you sort of think about it, these are two opposing thoughts, because tariffs are a tax. So they're able to sort of position one tax as favorable in the mind of one group, and in the mind of that same group, make them fearful of a tax cut expiring over here because higher taxes is bad. And I wish somebody would ask someone in the administration to help explain that just the juxtaposition and the seeming contradiction of those two ideas. Jeremy says, pass it, then impound it. Banna says, nah. Theta Trader, I haven't read it. Try to focus on what I can control, and the BBB is not one of them. Sub-Zero says, in favor for sure. Me no like paying taxes. Should be called the Big Beautiful Billionaires Bill. Yeah, bro, like it seems. Here's what I think is, I see a lot of what I see coming out of them. It's let's do this now, and this is going to create a bunch of new jobs, new opportunities for everybody in the future. So a certain group benefits now, and everyone else benefits theoretically in the future. But the problem with this level of thinking is, in the first administration, no one saw the pandemic coming. But there's this sort of unwillingness to accept the idea that you don't know what's coming tomorrow. You don't know what your economic economic adversaries could or would do, given what knowing what you need to happen. You bet on these certain outcomes, and because I know you bet on these certain outcomes, I can now create a counteroffensive because I know exactly what you need to happen, and I can prevent that from happening. So I think there's a bit of lack of risk management that's happening right now, because you're putting it all on black, and then what has to happen is you grow at 4 to 5%. What has to happen is you can't have a geopolitical escalation that ends up costing us more money that you didn't necessarily plan for. All of these other things have to happen, and when they don't happen, it's okay because you can pitch it to the people as, well, we never could have seen that coming. Well, yeah, sure, but a trader doesn't know that that's going to happen either, but we're responsible for managing our risk. Therefore, we have to be fiscally responsible. And shouldn't the government have to have some layer of risk management as well? Some acknowledgement that I don't know what's going to happen in year 2, 3, or 4 of my presidency. I have to make certain bets, but at some level I have to leave room for the idea that anything happens. And I don't see that level of risk management. I also don't there was one more bigger point that I wanted to make, and it just slipped my mind. But that's the bigger one. Oh, and then so what's happening is a certain class is getting the benefit now, and a certain class is being told or promised that the benefit to them will come later. But in exchange, what this other class is getting is culture war wins. So you give economic wins directly to this group, and then you give culture war wins directly to this group. And to me, I'm going, and this, no offense to anybody, I don't really want to get in a whole culture war discussion, but signing an executive order to tell me a boy is a boy and a girl is a girl, I'm like, you didn't really give me anything, by confirming the law of biology here, man. And again, I know some people have a different view in that, but from my point of view, from my worldview, I go, you didn't help me. That didn't help me in any way. You know what I'm saying? And so there's this interesting dynamic happening where it's like this group today gets economic benefits. This group today gets culture war benefits with a promise of economic benefits in the future. And that's kind of how I see that they're managing things at the moment. But at some point you go, I don't know. At some point I would wonder if this group is going to go, hey, I'm not really getting much. I was mad at all these other things, but really in the big scheme of things, they're probably things government shouldn't be involved in, point blank, period. And you gave me a bunch of EOs that are probably in the next 3 years going to be just all completely rescinded. So, what is Congress going to write something that has something to do with gender, stuff like that? It's never going to happen. So what did I really get to hold on to here? It won't pass the Senate, says Emmett Morris. In its current form, no way. I agree with that. But that doesn't necessarily mean that we're not talking about trillions of dollars added to the deficit. They might shuffle some things, right? They might not cut anything from SNAP at the end of the day. I don't think this bill in its current form passes. But you got to remember what they always do is they go way over here, so that I know you can't see it. They go way too super aggressive, and what this does is it anchors your mind in this thing that they're putting in front of you, and then a walk back of like 20% seems like it's a win, like, oh, okay, that's reasonable, when in reality they kind of just they got what they wanted, but by anchoring it in something that was like, you're going to take X amount of dollars away from SNAP or X amount from Medicare, you throw that in there, and now just taking those things away, that doesn't fundamentally change the trillions in spending, but it appeases somebody and it feels like a small win, and then you get it passed. This is kind of the way they do this stuff, especially the Trump administration. It does not help the middle class. Yeah, I don't see a ton of it's not a ton of direct wins, I would say, and that's the problem. I mean, the no tax on tip stuff is helpful, I think, to a certain class. No tax on Social Security, that stuff is probably helpful. I don't know how they're going to prevent people from gaming that no tax on tips thing. No idea how they're going to prevent that and not create unintended consequences. Good God, you guys had a ton to say about this. Buriange, I know I'm messing that up. Buriange says, Tasty Live, Victor Jones, anything that politicians agree with, I'm inclined to disagree with. I've been more right than wrong on that. Okay, I'm going to say something crazy, and then I'm going to get out of here. I'm going to say something crazy that's going to get me in a lot of trouble. So if this is the last show, it's been real. Let me see if I can bring this thing up. So whenever I see, I'm not actually afraid. I'm most afraid of anything bipartisan. Anything bipartisan, I'm terrified of. Absolutely terrified. I'm terrified of anything that's bipartisan. So I saw this thing the other day that this act was passed in a bipartisan manner, and people were saying, I saw in like the comments, which was like, I don't care what side of the aisle you're on. This is positive, or we needed this, or this is good. And just me knowing that 70% of the internet just all bots. And when I see that stuff, I don't go, this is natural or inorganic. I go, somebody wants me to believe that this is fine. I'm great. I'm out of my mind. Anyways, so I'm like, I should probably go read it. So I read, so let me say, the genesis of the Take It Down Act is the idea that if somebody posts something about some explicit pictures or something like that of you, that there's a mechanism to try to fix that. And I read through it, and I might be wrong in my interpretation, but the way that I was like, yes, this does address that core problem, and good on you. I'm glad we have some mechanism for that. God, why are you doing this to yourself, Victor? But then because there is this big profile case about this ring of impropriety that has happened, which ended in a person taking his own life, and there's still a question about where all that evidence is, and that's sort of working its way to being released. And there's Pam Bondi is talking about how there's all this video evidence. And then I go, well, doesn't this Take It Down Act it says it's not just deep fakes, right? It says this bill generally prohibits the non-consensual online publication of intimate visual depictions of individuals, both authentic and computer generated, and requires certain online platforms to promptly remove such depictions upon receiving notice of their existence. And I go, doesn't that make it illegal for people to post any Epstein stuff? I'm not saying that you'd want to see it, but like, doesn't that effectively make that illegal to even have that conversation? God, why did you do that, Victor? That's what I think about anyways. That's what I think about. So when I see this stuff and I see bipartisan and I go, okay, I understand the purpose of this act, but what's an alternative use case? And I might be totally wrong. I'm no legal scholar in any way, shape, or form. But part of me goes, how can this be used for a different purpose? And when I read that bill, I was like, yeah, I wonder if there was a different way to phrase this. Who knows? Maybe I'm crazy. All right, everybody, that's going to do it for me. Probably my last show. We will see what happens. Thank you. Do me a favor, hit the like button if you would be so kind. You can send me an email if you want to tell me how wrong I've been about at least that last point. My email address is victor.jones@tastylive.com. My Twitter is @VictorJones. The O and Jones are true. The O and Jones is 0 because I like to be difficult. Let me do that again. Victor.Jones@tastylive.com, or on Twitter @VictorJones. The O and Jones is 0 because I like to be difficult. This show is Synthetic Friday, so I won't be back until Sunday for First Call, and then we'll be back doing the Price of Truth. No. The Price of Truth is on, the Sunday's First Call has been moved to Monday. So we won't have the show on Sunday, given the holiday. We'll be doing it on Monday. So I will see you then, everybody. And then the Price of Truth will be back on Tuesday. All right, my friends. We'll see you back here next week. Peace.